Yeah, that's all. Yeah.
Ready to start the presentation. So please take your seats. Hopefully everybody who had was on our participant list, got an email about dinner tonight. So if you already signed up, then you're signed up. And if you want to take yourself off, please let us know. We need at least a rough count for dinner. So if you didn't sign up already, the dinner is at 6 at Solmona. And please let us know if you want to come so we can update the dinner count. But we hope you come because we always run out of time for discussion. And dinner's a perfect time to continue. So, all right, we turn it over to.
Okay, well, good afternoon, everyone. So we're very excited to be on the program. Thanks so much, Jan and Debbie, for putting us on it. So this is joint work with Pari, Tess, and Anna Maria, who are Anna and Pari are right here. Pari is going to be leading the Q&A part of it. Okay, so in terms of motivations, so for most households, their homes are typically the biggest thing on their balance sheet. So homes are the biggest source of wealth for households, and natural disasters like hurricanes and wildfires are increasingly putting this wealth at great risk. Now, a commonly held view is that homeowners insurance contracts protect this household wealth by allowing households to rebuild in the aftermath of a disaster. And under the standard view, it is households that are choosing coverage, their insurance coverage. So coverage choices reflect household preferences, household beliefs, and the extent to which they want to smooth shocks. What we will argue in this paper is that contrary to the standard view, it is in fact mortgage lenders that are shaping household choices, insurance choices in a big way. And the key to that is going to come from the fact that lenders actually impose these mandates. So they impose these minimum coverage requirements and have direct claims on the insurance proceeds. Okay, and as you will see, lenders are the ones, in fact, that constitute a significant component of insurance demand and an inelastic component of insurance demand. Okay, and we will also show that much of the financial protection from homeowners insurance contracts may actually accrue to mortgage lenders. And that is because these contracts, the central function of these contracts are to make sure households are able to pay down their mortgage balance in the aftermath of disasters, not necessarily to rebuild and smooth their own wealth shocks. Okay, let me set the stage on the institutional setting. So first off, insurance contracts have three things in mind. These are annual contracts, so they reprice every year. The key quantity that we are interested in is the coverage that you purchase on these contracts, and not whether or not you have insurance, but how much coverage you've purchased in these contracts. And that is the maximum amount that you are able to claim in case your property suffers a damage. The third thing is the price. So this is essentially the premium that you're paying per dollar of coverage that you've purchased. So that's the insurance contract. Mortgage lenders are going to impose these minimum coverage requirements. And the way these rules work is that these rules map two key underwriting variables into a required coverage amount. One is going to be the replacement cost of your home, which is basically what would it cost to rebuild your home in case it were to suffer a total loss. So think Palisade fires, what would it cost to rebuild your home? And the second important variable is the loan balance itself. Okay, so the picture on the left shows you the ratio of these two underwriting variables on the x-axis and what is the required coverage that you need to get on the vertical axis. There are two widely prevalent rules that we're going to focus on. The blue line is the rule set forth by the GSEs, Fannie Mae and Freddie Mac. And the red line is sort of a de facto rule that lenders practice widely in the market, as well as the FHA practices widely in the market. In the interest of time, I'm not going to tell you much about the GSE rule, and you will see in a few slides why. But let's focus on the de facto rule, the red line on this graph. So what this is saying is that you need to obtain, your coverage should be the minimum of your loan balance and your replacement cost. Okay, so up until the point where loan balance is exactly equal to replacement cost, up until that point, coverage should be equal to the loan balance because loan balance is the binding requirement. After that threshold, you then switch over to the replacement cost because replacement cost is lower than the loan balance. Okay, so up until this threshold of 1, you get the loan balance, at least get the loan balance, and then after that point, you have to obtain full replacement cost. So you need to be 100% covered. What's important to keep in mind that these rules, replacement cost and loan balance, completely pin down the exact amount of coverage you need to get, that there are these kinks in the rule that we will exploit, and that the rule itself doesn't depend at all on insurance prices. No matter what the price is, you're supposed to get your required coverage is going to be pinned down entirely by loan amount and replacement cost. So we're going to take this institutional environment seriously, and we will ask, well, what should we expect to see if households were the ones driving demand in the market versus mortgage lenders are the ones driving demand in the market? Okay, so if for households, insurance is a way to smooth wealth shocks. And so households are going to use insurance proceeds to rebuild their homes. And households, we typically think, would trade off coverage against premiums. And the key object for households is the cost of rebuilding the property, not loan balance per se. So if households are driving demand, then typically loan balance would not play a role. Certain models, of course, predict that loan balance might affect coverage choices, but they would have the exact opposite prediction than what we will find. Okay, so that's one. Second thing is, if households are the main drivers of demand, coverage should be relatively smooth over fundamentals. Coverage should be price elastic because household demand should be downward sloping. And the benefits, the proceeds of insurance would be primarily used to finance rebuilding. Lenders are, of course, different. Lenders don't necessarily care about households smoothing their wealth shocks. They want to make sure that their loan exposures are protected. So if lenders are the ones driving demand, then coverage should be tied to the loan balance in a positive way. So as loan balance increases, coverage should go up. There should be these kinks in the underwriting, around the underwriting thresholds, because coverage requirements mechanically change at those points. There should be bunching and censoring at the required limit. Demand should be price inelastic because the lender mandate doesn't depend on price. And that insurance proceeds should be used to pay down the mortgage balance. Okay, so these are the predictions that we will take to the data, and you will see that these hold in the data in a very strong way. Now, up until recently, it would be impossible to test any of these predictions because there was no data on quantities of insurance. What we are able to do is we have access to these really detailed individual level data that allows us to connect the insurance contract with the mortgage contract, with the borrower characteristics, as well as the exact property that loan is tied to. And this is going to be a national data set for over a decade. Okay, so here's our first result. First, we see extremely high compliance with the mortgage rules, in particular with the de facto rule. And that's why the rest of the talk is basically going to focus on the de facto rule for the most part. So what I'm showing you here is the coverage people get relative to the required coverage for these different regions of the underwriting thresholds. And what you see is that while the GSE requirements are partially enforced, there's very high compliance with the de facto rule. And in fact, the de facto rule alone explains about 70% of the variation in coverage choices in the data. The second thing to note is that there is extremely large amount of bunching at the loan balance. So this is showing you the coverage amount that people get divided by the loan balance. Okay, a ratio of 1 means you get coverage exactly equal to the loan amount. What do we see? We see, well, there is very little mass below the threshold. Okay, so households seem to be rarely obtaining coverage below the loan balance. There's also very large bunching at the loan amount thresholds. About 10% of households are exactly at that level. So this is suggesting that loan balance is acting like a binding coverage floor, consistent with the de facto rule. So this is already sort of telling us that loan amount is playing a big role in how households are choosing coverage. To sort of look at that in a more formal way, we're going to now exploit the kink in the rule. Okay, so just to remind you, the rule is minimum of loan balance and replacement cost. So at the threshold where loan amount and replacement cost are exactly equal, at that point, coverage switches from tracking the loan balance to tracking the replacement cost. Okay, so when the ratio is below 1, coverage should be equal to the loan balance. That's the binding requirement. When the ratio is above 1, then the binding requirement switches to become the replacement cost. And so that has a clear prediction on the pass-through of loan amount to coverage choices and pass-through of replacement cost to coverage choices. What is the prediction? The prediction is that below the threshold, loan amount should have a high pass-through. Above the threshold, it should have a low pass-through. And for replacement cost, the prediction is exactly the opposite. Low pass-through right below the threshold and high pass-through above the threshold. Okay, now households that are exactly constrained by this requirement, that are bunching, for them, we should expect a full sensitivity of 1. For households that are not exactly at bunching. For these households, we might also see a partial pass through to the extent that households index on this requirement in choosing their coverage in choosing their coverage in the data. Okay, so we should expect to see the same qualitative pattern of a switch in coverage tracking loan amount to replacement cost. And what we're going to test for is whether there is this discontinuity at this threshold in the pass-through shifting from loan amount to the replacement cost. So what do we see? We see exactly that prediction hold in the data. So what I'm showing you here is we're regressing coverage on loan balance and replacement cost and interacted with narrow bands of the loan to replacement cost, okay? And the coefficients are the pass-through estimates that we're plotting in these two pictures. So what we see here is that the coefficient, the coefficient on loan amount is high and it's stable. Okay, so this is saying for $1 increase in loan amount, coverage increases by about 60 cents. Okay, and that drops precipitously at the threshold to about 40 cents. So there's about a 20-cent drop for loan balance. You see the exact opposite pattern for replacement cost. You see a low pass-through for replacement cost below the threshold, and that jumps up precisely at the threshold to about 0.5, 0.6. Okay, I should mention that we're controlling for a rich set of fixed effects as well as borrower characteristics and a rich set of characteristics of the property itself. Now, these results hold even if we sort of narrow down closer to the bandwidth of closer to the threshold of 1. So I'm showing you results for the 5% bandwidth. And what you see is that the kink is robust to this narrow bandwidth, as well as adding a rich set of fixed effects and controls subsequently in these different columns, suggesting that unobservable characteristics of the borrower is unlikely to be driving these estimates because these estimates basically barely change as we saturate these regressions with additional characteristics. Okay, for us to interpret these estimates as a causal effect, the key identification assumption that we are making here is that absent the rule, coverage would evolve smoothly through the threshold. And so we shouldn't have discontinuous changes in things like households' preferences, beliefs, risks, or anything else that may be driving coverage, for instance, change in insurance markets. And so there are sort of 3 broad concerns that we rule out. One, that borrowers differ around these thresholds, so we don't find any evidence of that. There is no bunching, no discontinuity in household characteristics around the threshold. Our results are also not driven by measurement error in replacement costs. We externally validate our measure using additional sources, and we find our replacement costs on average as well as in growth rates closely match other estimates. And if anything, measurement error should attenuate these estimates, not create a kink, neither should it create a switch from loan amount to replacement cost. And a third concern might be that we are picking up a house price effect instead of loan amount. And that's also not the case. There isn't a bunching actually at the market value. When households choose coverage, they're not going and getting their market value in coverage. Okay, let me now move on to the second prediction, which is what do these mandates do to the price elasticity of demand? Okay, and we're going to argue that these lender requirements are making overall insurance demand inelastic. The key idea is that household demand should be price sensitive. As long as insurance prices are above actuarially fair, households should have a downward sloping demand curve. But the mortgage requirements are unrelated to insurance prices. And to the extent that mortgage rules drive demand, overall coverage demand would look inelastic, even though households on their own themselves might be quite price elastic. Okay, so to identify the role of these rules, we're going to estimate 3 different elasticities. First, we're going to estimate an overall coverage elasticity. So this is going to pick up the joint demand of both lenders and households. Then we're going to estimate an excess coverage elasticity. So just looking at the portion of coverage that is in excess of the loan balance. So this is going to pick up the discretionary demand that households have. And third, we're going to estimate a bunching elasticity to capture the fact that some households may have a demand below the loan amount, and as prices go up, they're going to increasingly bunch at the lender requirement. We're going to have an instrument that I'll spend very little time on in the interest of time, but happy to talk about it more during the Q&A. We're going to exploit the fact that in the US, insurance prices get regulated across states, and that there are a set of states which are highly regulated, okay? And in these so-called high friction states, the approval process is lengthy, as well as the timing of the approval is quite unpredictable. So we're going to exploit this random timing of approval in these high friction states as an instrument for low friction states, which are less regulated. The assumption here is that the timing of approval in high friction states are unlikely to be related to the demand conditions in low friction states, and we have some tests in the paper to show that that is likely to hold. As far as relevance condition goes, in other work, we actually show that insurance companies actually do not optimize prices, do not set prices state by state. They tend to cross-subsidize across states because of regulation. And that means that prices in one state are is a relevant object for insurers in setting prices in other states. Okay, so what do these elasticities look like? First column shows you the overall demand elasticity. And what you can see is that households are quite price inelastic. 1% increase in price would lead to just 0.1% decline in coverage. That fact masks how elastic households are in the discretionary component that they themselves choose. So that's the second column. So the excess elasticity is about 2. That's 17 times more price elastic than the overall elasticity. So as prices go up 1%, people are going to drop 2% of their coverage. And the final column shows that as prices go up, more and more households are likely to bunch at the loan amount. So all of this is saying that lenders are essentially making overall coverage look inelastic, even though households on their own are quite price elastic. And as prices go up, the lender component of coverage is going to remain protected because you're not going to go down below the loan amount. But the component of coverage, the discretionary component that actually protects household equity, that is going to shrink more and more as prices go up. Okay, so it is household equity that is going to bear uninsured losses as prices go up. Okay, so in the last bit, I'm going to talk about who benefits from these mandates and what is the mechanism through which these benefits accrue. So the starting point for us is the fact that lenders face losses after disasters if households happen to default on the mortgage. So keep in mind that this is also the state of the world when the collateral itself is damaged. So the recovery from the perspective of the lender is small relative to normal times. But insurance proceeds can make lenders whole if the proceeds can be used to prepay the mortgage, which might be possible if coverage is in excess of the loan balance. Okay, so we'll try and test this idea by looking at Hurricane Harvey and Irma. And we will ask the question, well, is it the case that households that have sufficient amount of coverage, are these households more likely to prepay or do they go delinquent? Okay, and what you see in this table is precisely this idea that more and more households are being switched from becoming delinquent to prepaying the mortgage. So households that have sufficient amount of coverage, these households have a higher propensity to prepay and a lower propensity to become delinquent. And to sort of quantify how big this switch is, we sort of take these estimates and apply them to households that suffered a total loss. Okay, and we find that coverage, having sufficient amount of coverage moves, first of all, a large fraction of households out of delinquency, but 3/4 of those households turn into prepayments rather than remaining current or rather than remaining current and likely rebuilding their homes. So all of this is to suggest that the mandates, the central function of the mandates is to make sure households are able to pay down their mortgage in the aftermath of a disaster, which basically means that lenders remain protected. Now, one key question is, clearly these mandates are making the lenders whole. What about households? So I want to be clear that households are also benefiting under this arrangement. And there are two sort of key distinct benefits. One, prepayment helps households avoid costly default. So that's one. The second benefit is once you have prepaid the mortgage, now you own 100% of the land. Even though the structure itself might be damaged, the land still has residual value and you now own 100% of that land. And so whether or not household equity recovers after a disaster comes down to these two things. Do you have excess coverage in your contract? After paying down the lender, do you still have any money left? So that's the first component. And the second component is what is the value of the land itself? And that depends on things like land share, how much land values have declined after a disaster, and so on. So in the back of the envelope, we find that if you sort of look at the households affected by Harvey and Irma, the average household lost about 20% of their equity. Now, there is heterogeneity around that number depending on how valuable land is and so on, but the average household loses about 20% of equity. And so that means households are still bearing residual climate losses even as lenders remain protected. A second implication that we're going to quickly talk about is that households are also bearing insurance price risk. So as climate risk goes up and insurance prices go up, households are the ones that are bearing the repricing risk. Lenders are lender exposures are going to be completely protected regardless of the price. As you saw, the households end up cutting down the discretionary component of coverage. And our estimates show that a 10% rise in price would lead households to drop 20% in excess coverage, which is about 24% of household equity. So a growing share of households' equity is going to become exposed to uninsured losses as insurance prices go up, but lenders would remain protected under this current arrangement. Okay, so let me conclude. What do we want you to take away? So if you thought you looked at the insurance coverage choices across households and you thought household preferences and beliefs are what is showing up in these coverage choices, you wouldn't be entirely correct. Mortgage lenders shape household coverage choices in a big way, and they do so by imposing these mandates. A central function of these mandates is to make sure households can prepay their mortgage, not rebuild after disasters. And this design leaves households to bear the brunt of uninsured losses as well as price changes. Now, one open question is, of course, if this is an optimal design from the perspective of household and lender welfare. Having these mandates at loan balance, of course, clearly protects lenders, but leaves households with some exposure, as you just saw. And a typical reason we think why we might want to leave beneficiaries with some skin in the game is moral hazard, which is unlikely to be in this case. The more realistic possibility is that lenders are simply correcting for some behavioral bias that lead households to underinsure in the first place. But they don't go as far as protecting the household exposure entirely. They only go as far as protecting their own exposure, so only up to the loan amount. A different question, of course, is why is it that lenders prefer these mandates over pricing climate risk directly in mortgage rates? So I'm going to leave you with those questions and looking forward to Anthony's discussion. Thank you so much.
Mhm. Okay, awesome. Thanks, Jan and Debbie, for inviting me to discuss. I will try to be brief, although I've got 20 slides. They had 15, so we'll see how it goes. Okay, so the way I think about a big picture question in this paper is, what is homeowners insurance for? Is it really homeowners insurance or is it lender insurance? Who benefits more from homeowners insurance? The way the paper sort of tries to tackle that question is by asking a slightly different empirical question, which is who determines the levels of home insurance coverage that we see in the data? And beyond that, who determines the price sensitivity of that coverage to changes in premiums? And then lastly, do the requirements that lenders impose protect lender claims after disasters? The key findings of the paper are essentially, one, coverage levels are strongly determined by these lender mandates in the sense that everybody complies with them. Not only do they comply with them, but they do so in a way that looks like they bunch kind of right at the mandates. And closely related to that, when something like loan amount is the constraint, the coverage levels are very sensitive to that. And when it's not the relevant constraint, coverage levels don't depend on it as much. In terms of elasticities, kind of the bottom line is these lender mandates render coverage levels inelastic in the sense that total coverage is very inelastic with respect to premiums, whereas that discretionary piece is elastic, and part of that comes from this additional bunching that you saw at that limit. And then lastly, yes, these mandates do protect lenders. After a disaster, full prepayment of the loan is going to be much more likely relative for people who have coverage that allows them to do that, and less likely for people who don't. Okay. Okay, so I think this, let me just give kind of my overview. I think this is an important paper. Climate risk is rising. Property insurance is becoming an increasingly important component of household sort of portfolios, or sort of the financial package that we all carry. At the same time that climate risk is rising, the price of insurance is also going up. And so it's very kind of relevant to be asking, are we getting what we're paying for with those rising prices, or are all of the benefits of that insurance actually accruing to lenders? I think the results are convincing. I have no doubt that lender mandates matter for coverage levels and elasticities. The paper shows that very clearly. I also, didn't need convincing that insurance protects lenders. They require it, and the paper shows kind of how that plays out after disaster. So I'm very convinced by what's in the paper. I've got 3 comments, mostly just about the sort of broad framing of the paper, and then 2 kind of smaller points just on some of the headline magnitudes from the paper. So first things first, just kind of on the framing, right? So the big picture question is, does homeowners insurance primarily benefit households or lenders, or how are those benefits shared across the 2 parties? I think there's somewhat of a gap between the analysis and that big picture question, in the sense that the question the paper asks empirically is who determines coverage levels, not necessarily who's protected by insurance. And, this is an implicit claim that the paper never actually makes this claim, but there's sort of this implicit claim that, well, if lenders are the one determining how much coverage there is, it must be that they're the ones primarily benefiting, or it's sort of this is lender insurance, not as much household insurance, or maybe not as much as you would have thought prior to reading the paper. There's sort of, we could view this 2 ways, right? So one way is like grant an extreme version of this premise, which is not what the paper is doing, but I think it's a useful benchmark, which is to say, take the coverage levels that you see in the data, and let's say that those levels were 100% set by lenders and with no input from households at all. And you could ask the question, how protected is borrower equity? If you look in the data, which by the way is incredible, you can sort of get a sense of that, right? So the average coverage level to loan balance is about 1.34. So people are insured for, a third more than their mortgage balance. The average ratio of their mortgage to their house is about 86%. So that means that the average sort of fraction of the house value that is insured is 1.15. So most households have more insurance than the market value of their house at the time they buy the house. If you take out the land component of the value, which is not really at risk, that's where sort of the average household is insured at 1.5 times the market value of the entire house, which means that sort of at current coverage levels, there is no insurance protection gap. Households are overinsured. Now, of course, that's not what the paper's doing. The paper's saying, well, those levels aren't 100% determined by lenders. There's a piece that the lenders does, and then households choose a discretionary piece above that, right? So you could sort of say, well, what happens if and it's that piece that's going to be price sensitive. And so what happens as prices go up, who bears the additional sort of risk? And, the answer to that mechanically has to be households, right? But that's not really a statement about insurance. That's a statement about the capital structure of the house. And so, homeowners are the residual claimant on value. Any additional source of risk, be it via pricing of the insurance or really what's going on via rising climate risk, is going to be borne by households, even if there was no insurance at all. So in some sense, it's almost not a paper about insurance. It's just a paper about kind of who bears residual climate risk, and that's going to be the equity. Okay. A related point, I think, sort of on the framing is that, and that's the sort of what the paper's getting at. As these prices rise, household equity is becoming increasingly exposed to this risk. And at some point, prices are going to get so high that we're all bunching at that limit because we just can't afford the insurance, right? And so if we reach that extreme point, does that mean that the lender at that point is now the sole beneficiary of insurance? And the answer to that question really depends on the perspective you take, right? So the perspective in this paper is something like this, right? It's a situation in which the house burns to the ground and all you're left with is the land. And of course, if your coverage level was only the loan balance, then yes, the lender in that case is the sole beneficiary of the insurance. Now, there's an alternative perspective, which is the one I would have as somebody living in the Midwest, which is that that's not why you buy insurance. You buy insurance for a loss that looks more like this. You know, there's a hailstorm that damages your roof. In a situation like that, in a partial loss, the lender's claim was never really at stake for most people, right? That the counterfactual is that I would have paid for that out of pocket. And so what the insurance does is protect my wealth 100%, and the lender gets essentially nothing from it, right? Which of those perspectives is right, you know, depends on which types of risk you're thinking about, right? But if you're thinking about the homeowners insurance market as a whole, you know, there's a case to be made that the latter perspective is kind of the bulk of the story, right? So the total losses are extremely rare. It's about 2% of all cases. So in 98% of situations, even if you only have coverage up to the loan amount, even if you let the lender pick your insurance coverage for you, you're going to benefit, and they're not. So I think the framing of the paper should sort of kind of emphasize the importance of this total loss thing, and kind of you know, put that in context. Okay, in the last little bit, 2 comments on magnitudes. Okay, so one on this first result about coverage levels, and then one on the elasticities. So, right, the key question, the kind of counterfactual in the paper is how much lower would coverage levels be without lender mandates, right? That's kind of what we're interested in, if we just let households choose freely. And the answer to that question is model dependent, right? So there's like the standard way you would think about this, which is we all have some latent demand for insurance coverage, C star. There's a lender mandate, and we get the maximum of those 2, right? So in that case, how much lower would coverage be if we remove that lender mandate? Well, some of us are constrained by the mandate. And if you removed it, then, you know, our coverage would go down by whatever the constraint is forcing us to kind of overconsume. And then there's a bunch of us who are not constrained, and so removing it wouldn't have an effect on us at all, right? So that standard way of looking at it, you could kind of benchmark this, right? There's a right way to do this, and then I'm going to do it the wrong way, right? So let's say that the fraction of us who are constrained is 10%, right? Which is actually generous, right? That's the entire mass here, really. You can kind of think of that as the extra. But let's say 10% of people are constrained. And if you remove the mandate, where would they be coming from? I don't know, like here somewhere, where the average of where the unconstrained people. Okay, if you did that, what's the reduction in counterfactual coverage that you would get if you remove the constraint? Well, for 10% of people, they're going to reduce coverage by about 20%, and then everybody else has no effect, right? So the average coverage level in the population would be about 2% lower than what we see in the data. The headline, one of the headline numbers of the paper is that it's much, much larger than that. So removing mandates would lower the average coverage ratios by something like 20% to half, okay? So how do you get that number? Well, you need a different, less standard model. Okay, and this is where the kind of reference dependence comes in, right? The way the paper's thinking about it is coverage levels are everybody satisfies the lender mandate, which is the loan amount, and then we have preferences that sort of we anchor on that, and we've got different preferences or constraints that lead us to want to close some fraction of the gap between what we have to consume and what the full replacement cost of our house would be. Okay, so you know, rearrange that. Coverage levels are loading on the loan amount and your replacement cost. And so even people who aren't strictly constrained by the lender requirement are going to have their coverage levels mechanically depending on the loan amount because of the requirement, right? And so in that case, what is the effect of removing the mandate? Well, just regress coverage on loan amount. That tells you how sensitive coverage is to the mandate, and then set that to 0. That's the dollar reduction in coverage as a fraction of existing coverage. So if you run that regression, you get that coverage level increased by 60% for each dollar increase in the loan amount. So that 1 minus theta is 60 cents, or if you just want to use this difference, it's like 20-some cents, right? So that's where you get the 18 to 48%. Depends on this assumption that even non-constrained people anchor very heavily on the loan amount as a way of choosing their coverage level. So which model is right? Is it 2% and we shouldn't think about this, or is it 46% and this is a huge deal? I think to conclude that these effects are large, you have to reject model 1, and you have to get as close as you can to sort of ruling in or accepting model 2, right? So the paper's got some convincing evidence that I think rejects model 1 in the sense that this pass-through exists even if you throw out those people who bunch. That should not happen under model 1. It's driven entirely by people who are constrained, and then some other suggestive pieces there. My strong suspicion is that the referees are going to want you to do more than just reject model one. They're probably going to want you to write down the preferences that generate this way of choosing coverage. And then beyond that, provide some empirical support for that way of thinking about it. So some ideas, right? So model one says this is all driven by the first order statistic. It's just the people who bunch, right? This reference dependence thing says, no, it's happening everywhere. Right? So you run your pass through regressions in quantiles. I should see it at every single quantile of the distribution. The whole thing should be shifting. But I think better than that, like show some explicit evidence of anchoring on this loan amount, right? You have people refinancing their loans. There are people for whom I have a coverage amount right now, and then I do a cash out refi and I have a larger loan that's still smaller than the pre-existing coverage level. The way you're thinking about it, coverage should track that new loan amount, even if it already exceeds it. So show me that that type of thing happens. Okay. Last comment. This is on the elasticities, and this one will be brief. Okay, so the paper shows the way we get at this elasticity thing is it shows the elasticity of total coverage with effective premium is substantially less than the elasticity of excess coverage, where those things are defined as total coverage and the difference between total coverage and the loan. Okay. So what fraction of that result is mechanical? Some fraction of it is definitely mechanical because I can remove the loan amount there and just put any constant less than coverage level. And I'm going to get that the total elasticity is substantially smaller by some factor. What's the factor? It's how close to the loan amount is the average borrower. Or, you know, for some people, this is a huge inflation factor. If I'm like 1% above, that's going to massively magnify this. So ideally, you would show sort of taking that Jensen's inequality logic seriously, you would show me kind of how much of that difference is explained by this factor weighted across everybody in your distribution, and then how much is there beyond that. Otherwise, this is just arithmetic. And then I think very closely related to that, and why I'm convinced it's not just this that's going on. You do have a true constraint, right? Because you show this increase in bunching. I would like to know how much of that gap is driven by exactly the fact that you're driving people back down to that threshold. Now, that does require you to sort of lean more heavily on that standard model. So there's a bit of a tension there between, you know, anything you do on bunching is saying the world works that way. But I think, you know, it would be nice to rule out that this isn't just mechanically what you would expect. But okay, anyway, those are my comments. I think it's an important paper. The results are convincing, just some stuff around the edges on framing and magnitudes.
Few minutes to respond.
Thank you so much, Anthony, for that great discussion. So a couple points. On the first point, you're absolutely right that when you take the borrower's LTV at origination, it is true that most of them will have coverage that protects both their own equity as well as the lender's position. So there's no protection gap. But when you think about a total loss event, that's going to include people at origination as well as people that have paid down a significant portion of their balance and have accrued equity in their home. So that's why our estimates from Hurricane Irma account for that equity that they've built up. And when you do account for that equity that they've built up, there is a protection gap. So it's this origination versus sort of outstanding, but we'll make that clearer. The second, this whole total loss versus partial loss stuff, you're right that most claims are for small things. But what we're interested in, and the biggest welfare benefits of insurance come from catastrophic events. And so if you think of the original Arrow model, he thinks the optimal insurance contract is a high deductible, full coverage contract. If you want to save money by kind of cutting your insurance contract, you should do it on the low end where the risks are small and the losses are small, but you should keep it for the high end. And what we're seeing is exactly the opposite. Households are cutting the high end, they're taking the tail risk exposure, and they're insuring the smaller idiosyncratic risks. So from a welfare standpoint, it's actually the total losses, these total loss events that matter the most, and the sort of partial loss events, which do represent the majority of homeowners insurance claims. Those are not as important because of because you're paying for it in premiums. And I'll just open up for questions now. Thanks. Yes. Yeah, we'll chat more. Jenny?
So I gave a. Oh.
Mhm.
Thank you. I believe lender mandate matters, but I feel another important player is not much discussed in your paper, which is the insurers. So I live in Virginia. I recently shopped my single family house insurance, home insurance, and 6 insurance company, not a single one mentioned the lender mandates. And also they give me totally different replacement estimates. They even allow me to negotiate what is my lowest to do it.
Right.
So at least I believe in many states, insurance underwriting is a key to determine how much insurance protection gap is determined. So I want you to talk more about that. And maybe there is a geographical variation across different states. It's jointly insurance underwriting and the lender mandates play a role.
Great. Can I answer or should I collect questions? Okay, I'll collect a few and then I'll get to that. Okay, oh, Jonathan and then in the back, yep.
And it sounds like that there's a bunch of, there's a mixture of behavioral factors here baked in and fully rational. And there's sort of an emerging literature in macroeconomics that tries to explain insurance behavior and risk aversion behavior based on exposures. In particular, I think one geographic shifter that might be of interest is local business exposure, or essentially the co-movement of other income locally with your house price. That potentially might inform sort of which fractions is optimally to insure and stuff. And based on this sort of demand side shifters, which are geographic, it might be interesting to sort of get at the fraction that is macroeconomically explained, sort of in the sort of quasi-rational manner versus it's an outcome of some kind of a behavioral negotiation or behavioral reference points or just an attention. Thanks.
My point was just a quick question on the instrumenting for the local price change. If I'm buying discretionary sort of extra insurance above what's required by the lender, is it possible there's a different relationship between the instrument and the actual price change that I'm perceiving because I'm in a more highly leveraged loan or something like that? So I guess I'm wondering whether you're allowing first stage coefficient variation there, because it could be different between the lender required part and the voluntary part. And you would interpret that currently as an elasticity difference. It would be a first stage difference.
I was going to ask a question about the total losses versus partial losses as well, since you have this incredibly rich data and you take out fixed effects for zip and year. I wonder if the geographic heterogeneity might actually be interesting about like the probability of total versus partial losses. And I ask because so I can do a public service announcement about a journal. So I learned about this from a paper that's forthcoming in the New Journal of Finance Insights journal, where they looked at similar data. And this wasn't a main point of the paper, but they were commenting that most losses from floods are not the catastrophic losses that you emphasize. They're actually partial losses. And so there they see the kind of insurance effects that Anthony was emphasizing. But for fire losses, they see a lot of loan payoffs. And they don't see the property sales, but they expect there to be property sales because the losses were total catastrophic losses and the homes were underinsured and they can't afford to rebuild. So they pay off the loan and expect to have property sales. So the different kinds of exposures in different localities might actually help refine your estimates, or I wonder if they would.
Okay, well, along these lines of the difference between total losses and smaller losses, as someone who's personally contemplated the high likelihood that one of my houses will burn down completely, as will the rest of the neighborhood, I think a lot of times in these catastrophic situations, you really wouldn't rebuild because the whole neighborhood is devastated. Or think about what happened in Southern California, like everyone I know whose house burned down has no intention of rebuilding their house, even though they can afford to and all that. So I feel like it's a little unsophisticated to think that if people want to insure literally rebuilding. Also the time to build is incredibly long in those situations. So I think what one is ensuring is maybe the ability to move somewhere else. And so it's not clear to me that you can say that people are kind of behaviorally choosing too little insurance. And then like on the insurers side, I've also felt like the insurers are really pushing people to insure at very high levels. So I think there's some countervailing forces also out there.
Okay, great. So that was a lot. So I'll just take a couple points. Insurers play a huge role in estimating your replacement costs. Some are good, some are bad. There's a ton of heterogeneity. There's some papers on this. Totally agree. In our context, for 90% of the sample, it's the loan amount that's the binding mandate, not the replacement cost. So even though there's a ton of that heterogeneity, what we're identifying off of is something we can perfectly measure, which is the loan balance. And so, and whether the loan balance is above or below the replacement cost may have some role to play, but it's relatively small. And everything we have has an insurer year fixed effect. So if there's systematic differences across insurers, we're kind of dealing with that. Our model is behavioral, but it's also rational in the sense that households are told by a lender you have to get the loan amount. And so anything they choose above the loan amount is their choice. And so in that world, it's hard to think that the household is sort of choosing a contract in an unconstrained way versus they're constrained if they only get the loan balance. So we'll try to kind of come up with the preferences that lead to this type of model. We totally agree with Anthony. And I think, Debbie, this gets to your point too. You're absolutely right. The literature so far is treating homeowners insurance as insurance for rebuilding, and we totally disagree with that view. We actually think this is the ability to prepay and move is a great thing, get out of a high risk area, and it protects lenders and it can protect households even though they bear some of the loss through their equity. So we'll try to maybe make that framing a bit clearer. We think this is not a bad thing that it's not protecting rebuilding. But it's just it's the literature has mistaken this. And I'll just say there are 4 papers in the AER on homeowners insurance backing out household risk aversion preferences based on their contract choices. And we think that that is totally wrong based on our results. So I'll leave you with that. Thanks, everyone.
All right, thank you so much, Jen and Debbie, for the opportunity to present this paper. You've had a chance to stare at the title for 10 minutes now. This is joined with Larry, who's here, and with Dimitris. And we're gonna use some data from the census, so the usual disclaimer applies. Okay, so broadly speaking, this paper is about how aggregate financial conditions shape worker earnings risk. Okay, the literature with the availability of large-scale, high-quality administrative data has taught us a lot about what that worker earnings risk looks like. So the distribution of individual earnings growth is very much non-normal. It has fat tails, it's very strongly heterogeneous, and it's cyclical. Recessions are times when especially the left tail of the earnings growth distribution expands. So now in principle, all of this sort of creates a clear scope for firms to insure risk-averse workers against idiosyncratic shocks, but in the data, they only partially do so. Now for this earnings risk, it's not the only component, but an important component is the extensive margin of job loss. The unemployment rate is quite volatile. It's of course highly countercyclical, and displaced workers, they face large, persistent earnings losses that roughly double in recessions. And now a leading explanation for these employment fluctuations that has been proposed, tracing back to the work of Bob Hall and subsequent work, sort of points to time varying discount rates as a driver of time varying employment unemployment dynamics. And in some of our prior work, we've documented direct empirical evidence that's consistent with this theoretical channel. Now in this paper, we want to move beyond just the extensive margin of employment unemployment and think about sort of the drivers of total worker earnings risk, and specifically also the cyclical component of that. So what drives this earnings risk, and then what are the welfare and any policy implications? Right, and so, to think about these, to answer these questions, obviously these dynamics are endogenous outcomes, equilibrium outcomes of workers and firms' choices, so that's why we need a structural model. And that's what we built in this paper. So we develop a unified theory of both employment and worker earnings risk dynamics, where we basically combine three key inputs. We have a directed labor search model combined with optimal dynamic wage contracts, and we take as an input counter-cyclical risk premia and think about the implications for worker earnings. And so in this model, the pass-through of shocks to earnings is fully endogenous. So on the within an employment match, the optimal contract has traits of an insurance motive, where firms are going to try to smooth wages for their workers, against a retention motive, where the optimal contract calls for backloading of wages to prevent workers from being poached by other firms. Right, but there's a limit both on the firm side and on the worker side in the extent to which they can commit to an employment relation, because any time that they're going to have an outside option that dominates their current contract, they're gonna leave because of limited commitment. And then this is going to be particularly salient at times when risk premia go up, because in our model, the net value of employment, the surplus of employment, is going to be a long duration asset. So when risk premia go up, employment values go down. So there's going to be more matches that fall below the separation threshold. So workers are going to lose their on-the-job insurance exactly at the times when they value it the most, when risk premia are high. So we're gonna take the quantities in our model seriously, and we're gonna calibrate the model by matching our empirical estimates of pass-through of shocks to worker earnings that I'll talk about in a second. And then what we find is that once we've calibrated to these pass-through coefficients, this model is going to generate replicate many salient features of worker earnings risk, even without directly targeting them immediately. And so this model is going to generate a widely dispersed fat tail distribution of earnings growth. It's going to create cyclicality in left tail earnings risk driven by time varying risk premia that go up in recessions. And it's going to also reproduce these large, persistent and cyclical losses that are associated with job displacement. And so once we have that calibrated model, we're going to use this model to try to answer some questions that earnings data alone cannot answer. And so we find that there's a substantial welfare cost of idiosyncratic risk that workers face, but it's not quite as large as what would be predicted by kind of a standard exogenous income process because of the endogenous responses that our model accounts for. And we find that human capital, even though firms are insuring their workers on the job, human capital as a whole is very risky to workers. It's going to be more stock-like than bond-like, especially for low-age, inexperienced workers. And then finally, we're going to focus on some state-dependent labor market interventions that are going to step in when risk premia are high, and those are delivering sizable welfare benefits, and there's going to be a trade-off between incentive effects for employment versus welfare effects through insurance. Okay, so what I'll do is, before I go into the details of the model, I'll briefly discuss our empirical estimates on worker pass-throughs that we use as a guide for the model. So we're using data from the LEHD, which is worker employer-linked data for over 3 decades, and we're focusing on workers that are initially employed by Compensat firms. We're gonna follow them over time, irrespective of where they end up. And then typically we're going to focus on persistent earnings outcomes. So we'll look at earnings over the next 1 to 5 years compared to earnings over the past 3 years. And this total earnings measure adjusted for age profile is going to capture both wage changes on the job, changes if you move to a different job, or it's going to be a zero if you become unemployed or non-employed. The main source of heterogeneity that we focus on is heterogeneity in earnings levels, and we do that by sorting workers within their firm based on the past prior 3 years of earnings. And then we'll look at the pass-through of different types of shocks. So our first fact is basically revisits what has been documented before on the right by our previous work and on the left by the literature. So where we're just looking at the average pass-through of different kinds of shocks to different types of workers, right? These are all quite heterogeneous, right? So if we look at productivity shocks on the left here, firm TFP shocks, they mainly affect the high-wage workers of the same firm. So it's basically flat across the distribution except for the very top. And this is very much an intensive effect, so an intensive margin effect. So it's actually still the low-wage workers that are most affected by productivity shocks, but overall, through their wages, the high-wage workers are most affected. And that's really quite different from what you get if you look at the effects of aggregate or even firm-level risk premium shocks. Because there it's the low-wage workers of the same firm that are most exposed to discount rate fluctuations. And a lot of this exposure happens through the extensive margin. So this is driven by exposed low-wage workers being more likely to end up separating from their initial job and moving into a non-employment spell when risk premia go up. Right, so that's I also talked about the extensive margin simultaneously. Now the new fact that we bring in, and that's going to be tightly linked to our model, is we also focus on the interaction of these two. Okay, so we're now looking at the time variation in the pass-through of firm-level productivity shocks to workers, and we can do this for all workers, but it's going to be most stark again for the low-wage workers, where the pass-through of firm-level shocks to worker earnings dramatically increases in recessions, and this is highly significant for low-wage workers. It gets less significant and closer to zero the higher up in the earnings distribution you look. And this is going to be tightly connected to our model, because this suggests that this insurance, the incomplete pass-through that firms insuring their workers against shocks, this insurance is going to break down to some extent in bad times. And we can also show that these results are again highly driven by the extensive margin, that recessions are times when productivity shocks are much more likely to lead to separation, in particular for low-wage workers, which increases the overall pass-through. Okay, now let me get to the model. Hey, so workers are going to be, they care about their own consumption. We're starting with standard CRA preferences with one key modification. All right, so we're writing CRA here in recursive form. Lowercase gamma is just standard risk aversion, but we're going to add an additional term, the capital gamma, that's going to separately account for risk attitudes towards aggregate risk. So the capital gamma captures aggregate risk attitudes, and then the lowercase gamma is risk aversion over idiosyncratic shocks. So there's gamma, the lowercase gamma is constant, but we're going to take time varying aggregate risk premia as an input. So the capital gamma is basically a radon-Nikodym derivative where that's going to depend on xt, and xt is going to be our time varying risk aversion with respect to aggregate shocks. And we have in appendix, we have one way of motivating that is through ambiguity aversion over aggregate shocks. Firms are simpler. They're owned by well-diversified, infinitely lived shareholders. So their stochastic discount factor is just beta, the rate of time preference, times this capital gamma, which takes care of the risk premia with respect to aggregate shocks. Okay, now when workers are employed, their productivity is going to be a combination of aggregate productivity and worker-specific productivity. It has these four different components. AT is aggregate productivity. It's very boring. The only thing that really matters is that this is the aggregate shock that gets priced by the stochastic discount factor. Now we have these three different components of worker productivity. H is permanent human capital, Z is persistent employment productivity, and lambda is job experience. Now, the distinction between these three components is not so important. Some of them is mostly on the quantitative side. What's important is that all of these three variables are highly persistent and are worker level variables. Z is going to be the main driver. Think of Z as sort of the main worker level productivity variable that's going to move around over time. But what's crucial here is that this H component, the permanent, is going to grow faster if you're employed than if you're non-employed. And that's very important for generating long duration effects in the surplus of a match. So that's the key role it plays. For the rest, think of sort of Z as the main worker level state variable. Now, workers are going to be hand to mouth, so they're consuming their labor income. The W is going to be the wage, the period by period flow wage embedded in the optimal dynamic contract if they're employed. If workers are not employed, they face a decision whether they want to search for a job and enter the unemployment pool. That's going to imply a particular flow payoff. They can also decide to not participate, and that's going to give them a different payoff, where the payoff in non-participation is not dependent on the worker productivity Z. And it's partially scaling with that if they're unemployed. Okay, so now we have a lot more in the model, but instead of showing you all of the notation and all of the equations, let me just kind of try to give you a brief overview of the main dynamics that the optimal dynamic contract is going to embed. Okay, so starting from the benchmark case, let's say the workers would sort of remain with their firms forever, or maybe only some exogenous separations. Then workers are risk averse. Firms are risk neutral with respect to idiosyncratic shocks. So the optimal thing is that workers are going to provide flat wages. So worker earnings are going to be flat as a function of productivity, because that's optimal insurance, and that allows the firms to just pay a lower average wage. Now, as workers get more and more productive, we're assuming here that the on-the-job search probability increases with productivity. So firms are going to be more and more worried that their workers are going to get poached by another firm, and preemptively this is going to lead them to increase wages as workers get more productive. And that's how we get this increase in pass-through at the high end of the distribution. And so there's a trade-off between the insurance motive and the retention motive on the job. Now, as sort of things deteriorate on the productivity side, that's where the limited commitment constraints are going to play into action. And so at some point, the wage stays constant, but the productivity gets lower. The firm is going to enter a situation where their net present value of keeping this match alive is at the risk of becoming negative. So in that case, the optimal thing to do, the match might still be viable, is to lower the wage. Which gets rid of this insurance, but is better than the outside option. So wages are going to get lower to kind of keep the firm involved in this match, and then up until finally, at some point, also the outside option of the worker is going to become binding, because as the wage gets lower and lower, they can go to their outside option, which is to enter non-employment and get potentially a higher flow benefit. And so because workers can also not commit to staying if their outside option dominates. So there's going to be a separation threshold. Low Z workers are separating, and high Z workers will not endogenously separate. Now, the final thing is that, and that's sort of where the time varying risk premia played a key role, is that because of this, at the margin, the net surplus of employment is a long duration asset. That value is going to go down when risk premia go up. So then the separation threshold is going to move to the right as risk premia increase, which plays a key role in generating the cyclical dynamics in our model. Okay, so we calibrate this model mainly to these empirical pass-through estimates that I showed you, combined with the asset pricing moments to discipline the SDF, and some basic labor market dynamics, the stocks and flows of employment and unemployment. Okay, so I don't want to talk too much about the model fit. The model fits these targeted moments reasonably well, and I want to focus my remaining time on the things that the model delivers without explicitly targeting them. So one thing we can do is, in not just looking at unconditional moments, we can actually feed into our model a month-to-month estimate of risk premium shocks that we're using in our empirical analysis. And if we do that, the model implied time series look quite similar to what we get in the data in terms of the unemployment rate, but also in these pass-through of productivity shocks to worker earnings, particularly for low-wage workers. But what I was already emphasizing before is that the implications that we get for worker earnings risk. Right, so the distribution of earnings growth rates in this model is going to be highly non-Gaussian. it looks quite similar to the data, and it looks very different from what you would get for the density of a normal distribution with the same volatility. And what we also replicate with our model is that low-wage workers have much more volatile earnings growth rates than workers in the middle of the distribution. Now, the cyclicality is going to be driven fully here by time-varying risk premia. So in the model, recessions are indeed times when the left tail of the earnings growth distribution expands. This is mainly because more workers are going to be pushed into unemployment. They're going to take longer to find a new job. But also on the right tail, the right tail shrinks, as in the data, driven by slack labor markets when risk premia go up. Less on the job, less jobs to job transitions, and less likely to find a new job out of unemployment. Now, finally, what the model also generates naturally is that there's going to be large cost of job displacement. So in the data, people typically focus on mass layoff events. In our model, job displacement here is an exogenous separation. So if you push people into unemployment, then there's going to lead to large and persistent earnings losses that are much larger in recessions when risk premia are high, because it's just going to take longer to find a new job. Okay, so our model matches all of these salient features of worker earnings risk. Now, in the remaining few minutes that I have, I want to think about sort of what we can then use this model for in terms of normative implications. So think about welfare and valuation effects and optimal policies. And these, critically, these objects are not observable for earnings data alone. So that's why we really need the structural model where all of these earnings outcomes are fully endogenous. And just to quickly illustrate sort of why that matters, if I go back to this job displacement cost, so if I compare on the left the long run implications in terms of earnings of losing your job, they're quite flat across the distribution, but they're very different than the actual welfare consequences of losing your job. Because separations here are when they're endogenous, they're privately optimal. Low-wage workers are much closer to the separation threshold, so they're going to get actually a pretty good replacement if they're put out of a job. So even though their earnings are going to be persistently lower, in terms of welfare, they don't hate this as much, and that's a big distinction here. Right? So this resolves the Bewley puzzle of why wouldn't workers just take a pay cut instead of moving to get separated from their firms. And here, actually, in our model, the marginal worker would pay zero to keep their job because it's privately efficient to separate. Okay, so in this model, focusing on the black line of this figure first, there is substantial welfare cost of idiosyncratic risk, even though the gamma that we take is modest, but workers face a lot of risk. So this is costly for them in terms of welfare. So that's about 25% of consumption, and it's fairly uniform cost of distribution. But it's quite different from what a standard model would imply if we're taking the income process as exogenous. So just taking one example of a typical replacement rate from the literature, something like 6.75% of average wages. In that model, the welfare costs are much bigger, and they're much bigger, particularly for the left tail of the distribution, where the cost would rise from 20% to almost 40%. Now, in this model, we have all of the endogenous evaluations, so we can think about how workers privately value their human capital, even though this is not traded. So their discount rates are high. They're highly heterogeneous in the distribution. The average discount rate due to idiosyncratic risk increases from 7% to 9%, but the difference is much bigger in the left tail of the distribution. And not surprisingly, because everything here is driven by time-varying risk premia, the human capital discount rate becomes very cyclical in this model, as it goes up a lot in bad times, in recessions. Okay, now finally, the last thing we do is we look at the effect of state contingent labor market policies, while we're either subsidizing unemployment benefits or we are subsidizing employment, but only in recessions, only in the 10% highest states of risk premia. In a balanced budget way by valuing them at the aggregate SDF, and because workers hate this idiosyncratic risk and these are very strongly affected by their time varying risk linked with these time varying risk premia, they really value these state contingent policies, and that makes them welfare improving. Right? So both of them, both subsidizing employment in bad times and subsidizing unemployment benefits in bad times, is welfare improving, but it creates a trade-off between incentive effects and insurance effects. Because for insurance and for welfare, it's better to subsidize unemployment benefits, sort of holding the total size of the policy, holding the total size of the policy fixed. But, you know, if we're subsidizing unemployment, that has strong disincentive effects. So we can kind of characterize that employment versus welfare efficient frontier for doing policy. And again, we can sort of emphasize that the endogenous worker and firm responses to these policies are crucial. So if we would hold employment and wages fixed, then we would find much lower both cost and benefits of these policies. Okay, so let me just wrap up. So, you know, we have this model where risk premia are a central driver of labor income risk that can reproduce many salient facts without directly targeting them about labor income risk that we can then use for welfare and policy questions where state contingent labor market interventions can yield substantial welfare gains. Now, the one thing is that we have kept the financial side as an exogenous input. So for future work, there's scope for thinking about financial market interventions, but we would want to think about endogenizing the stochastic discount factor as well. Right, thank you so much and look forward to the discussion.
All right. Well, many thanks for inviting me to discuss this paper. I learned a lot from it. So as you could probably tell from Martin's presentation, this is an ambitious paper. It's also a complicated paper. And let me assure you that Martin did a terrific job of being low key in terms of confronting you with all the complexities. So I'm going to begin by putting the paper into some data context and saying why I think they're tackling a very important question. And then I'm going to get into some of the mechanisms of the model and maybe kick some tires. And then I'm going to end again with a fact. Okay. So this is a set of impulse responses from some work I've done with co-authors. The citation is at the bottom, where we look at the relationship between predictable changes in 5-year excess returns of returns on the S&P 500 relative to safe interest rate, and what connection that has to macro aggregates. So the shock is it's not any structural identification. The shock is just identified as the thing that does the best job of explaining that 5-year excess return starting from at quarter T, starting from quarter T plus 1, going on for another 5 years. And then asking, well, what is the relationship between that shock and macro variables? And what you see is that it causes what we think of, and causes again in quotation marks, it's associated with what we think of as a classic recession with declines in output, consumption, investment, and employment. And the two little numbers on top, the first number is the fraction of the variance of that variable that is explained at business cycle frequencies, so like 6 to 32 quarters. And so you can see that that there is a strong association between predictable changes in excess returns and high frequency fluctuations in classic business cycle variables. So like about 50% of investment, output, and employment, but less, maybe a third for consumption. So this makes me quite interested in seeing whether changes in risk premia can match a much more diverse set of facts, much more detailed set of facts in terms of labor market outcomes. And that's what this paper sets out to do. So not just sort of what's happening to aggregate employment, but a lot more on top of that. Okay. So one thing that we did do, which is just getting a little bit at the heterogeneity of labor market outcomes, is looking at what happens to part-time employment. So note from the previous slide that aggregate employment goes down, and that includes part-timers. And so the left panel shows you what happens to the absolute level of part-time employment, and that goes up where aggregate employment is going down. And from the CPS, we can see why these people are taking part-time jobs, because they answer the survey question. And the vast majority say that they're taking part-time jobs for economic reasons. And so this is an interesting question for the model. I mean, of course, the model doesn't literally have part-time employment, but I think it would be complementary to think about one of the options for somebody who is separated from what I can think of as a primary labor market, at least starting in a CompuStat firm. And then if separated, might take what you might think of as a job in a secondary labor market, part-time work for economic reasons. It would be interesting to know who in the model is mostly initiating the separation, because this pattern of leaving employment, full-time employment, and taking part-time employment suggests that the worker isn't deliberately setting out to go into non-employment. And Martin's presentation suggested that at least the marginal worker is kind of indifferent between working and not working, and maybe this is not so consistent with that model prediction. So it would be nice to kind of dig into this in a little more detail. Now, note that I said that this is an association in the sense that we don't have a structural identification of what's causing the excess return to move around. So, of course, we wanted to see if there's some deeper underlying shock that could be driving, say, both the business cycle and the change in the excess return. And a natural candidate is a TFP shock. And what we found is that the shock that we identify as the one that does the best job of explaining the excess return doesn't really seem to have much contemporaneous correlation with changes in TFP. So at least over the first 5 or so quarters, there's basically no significant change, and the point estimates are, if anything, a little bit positive and not negative. Now, over the longer term, there is a decline, but note an increase in the risk premium will cause a decline in investment, including things like intangibles and R&D, which would show up as a decline in TFP. So I would be inclined to see the long term as more of a consequence rather than a correlated shock. This is rather different from what the model assumes. The model assumes a perfect negative correlation between changes in the risk premium and aggregate TFP. These things should have different effects in the labor market. So an increase in the risk premium, exactly as Bob Hall said, should hit investment in the sense of firms posting lower vacancies. It's not obvious to me that there would be a direct effect on employment. There could be indirect effects through general equilibrium changes. But I think we would really want to see what happens in the model if there's a pure risk premium change with no change in TFP, and then for comparison, a change in aggregate TFP with no change in the risk premium, and then hit the model with both shocks, but with the empirical correlation that's found in the data rather than assuming the perfect -1. I think that those would be more informative experiments to report. So let me talk a little bit about implicit contract, because this is a model about implicit contracts and the relationship to wages. So in a classic and wonderful paper that I really recommend, if you haven't read it, by Gary Becker in 1962, he pointed out that if under kind of classic conditions where both sides have full commitment, everybody has equal access to borrowing and lending and so on, that there is only a present value constraint between the set of marginal products that a worker delivers to a firm and the wages that the firm in exchange gives to the worker, right? So once the present value constraint is satisfied, the time path of wages can be anything. It can be very smooth, it can be very volatile, it doesn't matter. Okay. So fast forward many years, Mariana Kudliak sort of took the Becker view and then asked, well, if that's roughly the way, an implicit contract way that firms and workers think about wage payments, then what is the wage associated with a single period's marginal product? That is, what does the firm equate to the marginal product at time t? And what she pointed out is that it should be this period's wage, easily enough, but also the expected present value of the difference between hiring the worker at time t with an implicit contract that begins at time t. So note the highlighted t subscript on the first wage, minus hiring an identical worker at time t plus 1 with the implicit contract that is indexed to economic conditions at time t plus 1. And so what Mariana showed is that what she called the user cost of labor, this object, is the allocative wage under full commitment. You can basically see that from the Becker equation, but also under some forms of limited commitment. And the important part for much of macro labor is that she found that this user cost of labor is much more procyclical than either the average wage, say average hourly earnings, which are basically acyclical, or even new hire wages, which are considerably more procyclical. And that really matters for a lot of macro labor questions because many of our models just work much better if allocative wages are sticky than if allocative wages are highly procyclical. Now, I should make it clear that Mariana's exact user cost is not the allocative wage in the model that Martin presented, because the model has endogenous separations and it has a time-varying risk premium, neither of which is allowed for in the user cost construction. But the nice thing is that Mariana and other authors have empirically estimated the user cost and cyclicality, and it would be an easy moment to estimate in the model to make sure that the allocative wages in the model haven't been assumed to be too rigid. And as I noted, sticky allocative wages are going to make it easier to match fluctuations in labor market tightness, vacancies, and unemployment. But in order to be realistic, those predictions need to be consistent with the evidence we have on the user cost of labor. So let me talk about one more piece of the model that I found well, at least worthy of discussion, which is the constraint in the model on matching outside offers, right? So we probably all know of people who get outside offers and have that outside offer matched by their employers, so that no change in employment location takes place. But in the model that Martin presented, this is not allowed. There's just a hard constraint that firms are not allowed to match outside offers. So they can only backload wages in order to induce workers not to leave. So this is a way to make young matches fragile and easy to destroy, because a lot of the payoff, if you're a worker just starting out, a lot of the payoff to your employment is going to come long ways down the road. If you stick with the firm for a long time, then you're going to get high wages. But then if there's a change in either TFP or in the discount rate, then those one party or the other might think that those wages down the road are just not worth that much and destroy the match. Whereas it would be I think quite reasonable to think about a different setup where the firms would adjust wages to outside offers to prevent costly separations. And this is the way it's done in the classic wage contracts with limited commitment paper by Thomas and Worrell. So obviously, in any model, the conclusions are going to follow from the assumptions. But as a co-author of mine likes to say, there should be a gentlemanly distance between the two. I guess the question is one of taste. Do you think that that this is too obviously a backward engineering way of fitting the data, given that there's not a lot of empirical support for saying that firms are not allowed to match outside offers? Okay. So one suggestion I have is that given that there are so many mechanisms in the model and they're all doing important and different things, is there a way to map this long list of model assumptions to some more basic summary statistic? And I was wondering, and the authors will know better, whether one possibility is the Lundquist-Sargent fundamental surplus, which would of course be different for each worker type. In a large class of models, as Lundquist and Sargent showed in their paper, the fundamental surplus shows how each kind of model mechanism, for example, sticky wages, limited or costly external financing, and so on, reduces resources available for vacancy creation, and therefore reduces employment after a shock. I mean, is it possible to take some of the mechanisms I've talked about and many more that are in the paper and kind of say, here's how each of them contributes to something like the fundamental surplus? Okay. But having said all that, I want to conclude by really congratulating the authors on putting a new and I think important fact on the table, which is that in microdata, a higher risk premium is associated with a lower pass-through from firm TFP to worker wages. And so, while I think one can take issue with a lot of the details of the model, and I've discussed a few of them, I think it's important to bear in mind that whatever alternative model we want to put forward should also be able to match this fact, since their model is able to do so. Okay, let me stop there.
All right. Well, thank you very much for all those helpful comments. I take the point about moving parts and trying to simplify them more. So we've thus far tried to deal with this by showing that, we're going to discipline the model by a lot of the empirical results on pass-through and things like that, which helps explain insurance. It's nice that there's not a lot of tension with a bunch of other facts that Fatih Guvnen, among many others, have demonstrated in the admin data. But point taken, we can also do some of these model consistent things and think about benchmarking those. So, there's obviously, you got to stop somewhere. Many of you would probably stopped earlier than we did, but we wanted to get the model to speak to many things. So we didn't put something like a part-time margin. But if you kind of think about the logic of our model, I think it would naturally, right now we sort of have employment or unemployment or full non-employment. You can imagine that the key thing is basically a duration mismatch. It's that the best jobs, you're sort of accumulating experience, and that experience stays with you your whole career. That's very sensitive to your to discount rates. And then your outside option is kind of less tied to that. If you think about part-time is somewhere in between, you can imagine that the same type of intuition would apply to that state. So it would be natural to think that kind of part-time jobs, if they're less tied to my specific productivity, I just need to be kind of conscious and hardworking, et cetera, that I could do that. So, a lot of the other ingredients, I think we added on the job search in a very specific way to kind of help with contracting and some features we know are true of contracts. I would say that our model would play really nicely with one of the other mechanisms that this literature is often thought about, which is a job ladder. So right now, there's no real reason for people to switch between jobs. It's just purely kind of welfare destroying. In fact, you could provide better insurance through the firm if there was no possibility of workers leaving. But kind of in the real world, people try to find better matches over time, and investment in those kinds of creations of better matches, that's also going to fall. And so we think that would actually interact with all the mechanisms we're thinking about here in interesting and important ways. But we decided gotta stop someone. So we decided for this paper, we weren't gonna go there. And point taken as well about TFP shocks and discount rate shocks not being perfectly correlated. In our other paper, coming out of the AER soon, we fought a lot with that, and they're not perfectly correlated. It's about 40%, minus 40% is the empirical correlation. We just wanted to take one additional degree of freedom out of the model to kind of focus on the key economics here. So there's kind of other TFP shocks that we didn't put in. Yeah. And if I could collect no more than 3 at a time, that would be really helpful for my memory, if that's okay. Yeah, go ahead.
It's a very cool paper. I was thinking a little bit even by looking at the discussion, if you thought about kind of like the reverse causality on it, like, okay, you get this like this risk premium end up affecting how much the firm absorbs on TFP but what if like I get news about future productivity, which is usually associated with lower risk premium? That's the mechanism and not really like from risk to TFP.
I was a bit puzzled with the way you specified the workers' problem. So I was wondering whether you could say something about that. So you have this stochastic discount factor, which is very volatile, and the worker, they cannot save or borrow. And then their labor income risk has both aggregate and idiosyncratic components. So it's a bit of a non-standard way of setting this up. So I was wondering whether you could comment. You justified a bit, but I would have expected you do the reverse. You do it on the firm side, and then that translates to the worker, but you chose it to put all the risk on the worker, and then has implications on the stock-like properties of labor income.
I just want to clarify one of your pictures. In your model, you have aggregate shocks, hence risk premium, but then absent, so in models with limited commitment, which is yours, consumption should not be flat even when the limited commitment constraints do not bind. But in one of your pictures, I think maybe multiple of your illustrations, consumption is flat, but that shouldn't be the case because marginal rate of substitution should be moving with stochastic discount factor given the aggregate shock. So is that illustration
No, it's
a special case where you shut down aggregate shocks?
under the assumptions that we make. We actually show this in the paper. Under the assumptions that we make, the optimal thing to do is for the firm to have a flat wage conditional on these bonds not binding.
No, but that can't be the right solution, right? Because absent aggregate shock, consumption is flat when constraints do not bind. But when you have aggregate shocks, consumption has to be stochastic because you want to tie it to the marginal rate of substitution. You have to pass, even on the optimum contract, you should pass aggregate shocks to a certain degree to workers, even when the limited commitment constraints do not bind from either consumer or worker sides. Right?
Go ahead.
So is that
the workers slightly care more about this than the firms. So in our case, it's still optimal. So yes, the firms hate this too, but it's still efficient for the firms to provide as much assurance, which is basically keep it flat as long as they can. That we can
talk about that, but I think the beta, the firms want, the workers want the betas anyway. So it's
also keeping the graph we made had an idiosyncratic shock on the x-axis, not an aggregate shock.
Yes,
only that's true, but otherwise.
But it was an idiosyncratic shock I was plotting. Okay, so I got 3 and then okay, so reverse causality. So I'm going to punt a little bit for this paper and say read our other paper because half the other paper is fighting that battle. In the data, there's lots of variation in stock prices and aggregates that is kind of on productivity type shocks that move the quantity of output, they move consumption, et cetera. They don't move the risk bearing capacity of the economy, and trying to separate that. Is it just that risk premium rises in recessions and this is all about recessions? There's like lots of ways of getting that using controls, using shift share type things. And you really find that there's this kind of very special effect that comes from risk premium. And you also have identification in the cross-section of people, and that you can look at, for example, young workers versus old workers, or people who are in careers that have very steep earnings profiles versus very flat earnings profiles. All these things, both qualitatively and also even quantitatively, if you do kind of model analogs, line up very, very nicely. So it really looks like, an investment in human capital that the worker is kind of doing. Like the key insight from these papers by Pat Kehoe, Virgilio Mitrogan, and Elena Pastorino is basically that human capital is a very long duration asset. Even if jobs only last a few years, the benefits of, in terms of what you learn, or at least protecting your skill from depreciation, they kind of live on with you throughout the rest of your career. And it's very sensitive to interest rates. And so there's lots of tests in that paper that are consistent with that idea. There was a question about why worker preferences are this way. So the short version is, if you kind of need both workers and firms to feel similarly about aggregate shocks, because if they don't, you're going to have lots of very strange things that happen in this model. Basically, workers are going to be providing all sorts of insurance to firms and not vice versa. And so kind of what happens here is basically there's this component of expected marginal utility that goes up in bad times for workers because income risk is going to go up for them. And so that's going to make them want to get kind of extra insurance from the firms because they're going to be unhappy due to the idiosyncratic part of their preferences. And so if you don't have some way of solving the equity premium puzzle, like so that workers and firms kind of feel symmetrically about these shocks, you're just going to get all sorts of things that look not at all like the data, I would say. So that's kind of how we've thought about that ingredient. Other questions?
Okay, well, if not, thank you very much.
All right.
And we have a break until 2:55, so I'm back for the second half.
Great. So that everyone, including authors and discussants, re-enter the room. Presenting on. Okay, great. Oh, and looking around, because Jonathan isn't back yet, but he's my favorite. He's the least important person. Sorry to let you get started. Thank you.
Okay. Well, thanks, Debbie. Thanks, Jen, for including this paper on the program. So this paper is Target Allocation Fund Strategic Complementarities and Cross-Market Fragility. Is joined with Itai. Itai is also in the audience. So Itai told me that the time right now is actually the time for the World Cup. I think it's France versus England. Literally right now. So I appreciate your time for staying here instead of watching the World Cup. So we're going to talk about this target allocation fund. So what are they? These are funds with explicit allocation targets, right? The conventional target allocation funds is just think of it the mutual fund. It literally says we're 60-40 funds or 80-20 funds, right? But the bulk of the target allocation funds I'm going to talk about are these target A funds. I'll talk more about what they are, but they're the ones that have grown substantially because they become the default 401k plans. Default option in 401k plans in the early 2000s, and since then they have grown very fast, exponentially. So the paper is going to focus on the first two groups, these registered investment funds, target A funds, and conventional target allocation funds. But let me just mention that there are also pension funds, endowment, collective investment trusts. These vehicles also have target allocations, but the thing is they don't report detailed data as these registered investment funds. So we're going to use these registered investment funds as sort of like a window into what the target allocation funds in general do. So it's broader. So the point of the paper is to focus on the fact that these target allocation funds make predictable rebalancing trades. So for example, if I'm a 50-50 fund, okay, 50% equity, 50% bonds. What happens when the equities go down? So there's a negative return to equities. Well, I need to sell bonds and buy equities, right? So if I want to maintain that 50-50, that's what I'm going to do. The point, the focus of this paper is to look at the market implications. And then let me just mention that there's a very nice paper published in the JF. Our discussant wrote this. It's a paper that emphasizes that these rebalancing trades dampens the equity market shocks. Right. So if there's a equity market shock, equity goes down, they're going to buy equities. So partially reverting that shocks, right? So it's like it flows to the equity markets and buying pressure there. We're going to look at the other side of the same coin, right? So Jonathan actually also studies the bond side, but we're going to do it in greater detail, and we're going to show, interestingly, the strategic complementarity part. So we're going to show that now equity market shocks are going to be amplified in transmission to the bond market and the implications of that. So to illustrate that, let me bring you back to the good old days in COVID. And one of the most salient things that happened during COVID was these historic outflows from the bond mutual funds. So the graph here shows you the net flows, the aggregate net flows in and out of bond mutual funds. And you can see that in 2020 Q1 circled in red, there was this massive about $200 billion of net outflows from bond mutual funds. Right, $200 billion is a lot, right? So it's a size of equivalent to a kind of a QE. So it's like a QT in the market, very massive. And then it caused a lot of disruptions in the bond market, and a lot of people were wondering why that happened, right? So usually bond prices will go up. It's a safe haven assets, but in this case, in COVID, bond market was significant disruption. Treasury prices and these high quality bond prices actually went down for a little bit, and people have linked these disruptions to the outflows from bond mutual funds, right? So we're having outflows, they need to sell the bonds. But why that were there large outflows from these bond mutual funds was less understood. So we look into the data, and then interestingly, about 30%, 35% of the outflows can be linked to these target allocation funds. So one important feature of target allocation funds are they're funds of funds. Okay, so they invest in equity and bonds, but they invest actually indirectly through other mutual funds. They invest in equity funds and bond funds. So when they rebalance, they redeem or purchase share of these mutual funds that subsequently buy and sell the equities and bonds, right? So this layer is actually very important for our story. So these target allocation funds, as I said, equity prices went down during COVID by about 30%, right? And bond prices were largely fine. So what they need to do? They need to sell bonds. Well, specifically, they need to redeem their bond shares and then buy equity shares, right? So magnitude-wise, as I mentioned, they account for about $60 billion of the outflows from the bond mutual funds, so about 35%. So it's pretty big, right? If you look at their total portfolio, so not just how much they sold the bonds, so the red bar shows you the net purchases of the bond funds. So that's the 60 billions of net outflows that I just showed you. If you look at their whole portfolio, the story is crystal clear, right? So they were buying equity fund shares in the exact same amount, right? They sold 60 billions of bond fund shares. They bought 60 billions of equity fund shares. They were exactly doing this rebalancing trade. Okay, so that was the illustration. So we're going to do much more from there. So the first part of the paper, I'm going to show you that these target allocation funds rebalance in a very highly predictable manner. So specifically, I'm going to construct these theoretical amount of rebalancing. So given the realized equity and bond returns, this is how much they should buy or sell. I'm going to show that moves one for one with how they actually buy and sell. Okay, so the theoretical trades is one for one with what they actually do. There are some nuances with the effect of liquidation cost. The core part of the paper is to show that this rebalancing, this TAF predictable rebalancing triggers strategic runs by other mutual fund investors. Okay, so when the target allocation funds are predictably redeeming out of the bond funds, the other investors, they see this or they anticipate this, they strategically redeem out of the bond funds as well. I'll show you the mechanisms, but that's roughly the story. So this story is strategic complementarity, right? And we'll argue that I'll show you that this is we think is a pretty clean test of the existence of strategic complementarity. And then a headline number is so we do some quantification, the amount of rebalancing done by target allocation funds and the strategic runs from other investors, if you combine them up, that account for about half of the total outflows from COVID. Okay, so we capture. So what I'm telling you here captures about half of the story of where were there large outflow from the bond funds. If I have time, I'll show you some asset pricing implications directly. For example, I'll show you that these rebalancing trades and the strategic runs affect the aggregate stop on correlation. Okay. In terms of contributions to literature, I'll be very brief. Let me just mention that we contribute to understanding the market impact of rebalancing. Most importantly, I think we contribute to showing a direct test of strategic complementarity, and then we contribute to understand the bond market turmoil during the COVID-19 crisis. Let me jump right in. First, let me just give you some background in this space. So what are these target allocation funds? So first of all, conventional target allocation funds, you can Google, target allocation funds, and these results will show up. For example, here's the Fidelity target allocation funds. They give you a menu, right? They give you a different kind of funds. You can invest in 20% in equities or 85% in equities. So there's different risk tolerance. But as I said, the main part of these target allocation funds, the biggest one now, are these target A funds. if you work in the US, you should know about them because they're probably your default 401k options. So the x-axis are the horizons until retirement. So you retire here, and these are the years until you retire, and it's the years after you retire. And then the allocations shift gradually over time, right? So initially you'll allocate a lot more to equities, international equity spot. But later, gradually you will have more bonds and equities, right? So like you take less risk. Johnson's paper showed this, at a given point in time, this year, so these are years, right? At a given point in time, it's effectively a target allocation. So these target allocation funds have grown substantially, mainly because of the target date funds. These are the red bars, because they became the default option for 401k plans. So they're over $2 trillion now. It's very big. Usually it's usually it's a bad idea to show you raw data, but here I think it's actually might be helpful. So here is the holdings by the largest target allocation funds in our sample. We didn't cherry pick, we just picked the largest fund. So you can see, so this is a Vanguard Target Retirement 2025 fund. So people investing in this should have retired. You can see the fund has 5 positions. Okay, so these are the holdings in end of 2019 and then after Q1. The fund has 5 positions. Okay, it's not like they invest in a bunch of funds. It invests in 5 funds. If you look closely, there's a Vanguard Total Stock Fund, Vanguard Total Bond Fund, Vanguard International Stock, Vanguard International Bond, right? So, and then there's a small negligible money market funds. So those are the 5 funds. And then, after COVID, this is shown in red. It's still the same 5 funds, and then the allocation, so there's a percentage TNA, the portfolio weights barely changes, right? Even though during COVID there was huge returns and the portfolio rates should have been knocked out of the balance, but they remain remarkably stable. So that's sort of the gist of the story. They do active rebalancing to maintain a pretty fixed allocation over time. And then it's very predictable, right? So it's not like I'm going to go out and buy a new bond fund or a new equity fund. It's the same 5 funds over time. Okay, so let me skip data and then tell you how do they rebalance, okay? So we're going to construct a measure of how, so we can basically predict how much they're going to rebalance based on the realized returns. Okay. It's very simple. So, suppose W star is your target portfolio weights to a fund. All right. So the left-hand side is going to be the target allocations, is the AUM times W. The right-hand side is the realized allocation. So suppose you started with W star, but then return happens. This is your realized allocation. So you expand out what is the AUM today, it's the AUM last period times returns plus the flows. You rearrange some terms and you arrive at you can basically get this, you can decompose this predicted trading into 2 parts. One is the rebalancing induced trading. So this is due to the returns of the funds that you experience. And if you look at the things in the bracket, you can basically see it's because of the return differences. Right? So it's not just because of the returns themselves, it's about the return differences. So if all the funds have the same return, they all rise or all fall, that term is still 0. It's really there are different returns, and that's why you need to rebalance. So that's a rebalance induced trading. A large part of this is in some sense just copying from Johnson's paper. But the thing that we extend, and we think is a valuable extension, is we allow for heterogeneity across the funds. So for example, a domestic equity fund and international equity funds can have different returns, and we allow for that. So we think that captures the rebalancing trade more accurately. So here's how the rebalancing induced trading stand up against the actual trading. So the blue bar shows you the actual amount of trade. This is what I showed you at the first 2 slides. It's about $60 billion of redemptions from the target allocation funds. The red bars shows you the theoretical predictions that we just measure. It's basically 1-for-1, right? Same with equity funds. So that was bond funds. This equity funds is basically 1-for-1. You can run a regression using investor position level data, include a bunch of controls and fixed effects. It's 1-for-1. Okay, the coefficient is 1. There's some interesting differences between the negative part and the positive part. So rebalance induced purchases versus redemptions, but still it's very close to 1. You might have this question, okay, do they need to stick to the target allocation that closely, right? So if the transaction costs are high, maybe I deviate a little bit from it. And we do find that. So in this regression, we include how illiquid this fund is. So it captures the transaction cost. And you basically see that the more illiquid the fund is, the less they do this 1-for-1. Right, so because they care about this. But interestingly, importantly, this only matters for affiliated funds. Right? Why is that? Because, so remember, these are funds of funds, right? So the target allocation funds invest in mutual funds. So they don't invest in the bonds, they don't buy and sell the bonds themselves. The underlying mutual funds do that. So they're removed from the transaction cost. But if the underlying funds, if the mutual funds investing are affiliated, then that transaction cost is internalized. Right, so they do care about this. So for unaffiliated funds, it's fully external, so they don't care about that at all. Okay, all right. So that was the first part. I'm running low on time, so I'll be a little bit quicker. So let me show you the central part of this paper. Okay, so if the target allocation funds do this rebalancing in a highly predictable manner, they're going to trigger strategic complementarity from the other investors. Okay, so let me do a quick review of how it works in the setting of mutual funds. So how strategic complementarity works for mutual funds investing in illiquid assets. Okay, so that's an important setting here. So mutual funds investing in illiquid assets, so they basically perform this liquidity transformation. Right, so there's a mismatch between the mutual fund claims and the underlying assets. Now, for example, they invest in corporate bonds. Suppose there are 3 investors, right? So, me, Debbie, and Jen. We're in the fund where the 3 investors each holding a share, and the NAV is let's say $10. Okay. Let's say I need to run. Okay, so because I'm the target allocation funds, and stock market just dropped, so mechanically I need to redeem from the funds. Okay. What needs to happen? Well, this is the fund needs to liquidate the bonds to pay me because I'm getting out. So that's going to incur some liquidation costs, right? Because these are illiquid assets. Think of it literally as a bid-ask spread, right? So there's a lot of people think about price impact, but think of it simply as bid-ask spread. Okay, so the bond is $10. If you buy at 12. If you sell at 8. The price can just be constant. All right. So if the fund sells the bonds, they incur this bid-ask spread, let's say $2. Okay. The important question is who bears this $2, right? So in an ideal case, the 3 of us should share it. But even in that case, I'm imposing liquidation costs on Debbie and Jen. Right, they're going to share some of the liquidation cost. In reality, more likely than not, they will actually bear all of it. There are several reasons for it. I'll tell you one institutional feature in this market, in the U.S. mutual fund market that causes this, is because of the timing of how the NAV is struck. Okay, so for example, if I redeem at 3 p.m., I submit my request to redeem. I suppose I submit it through Schwab, like my intermediaries. The intermediaries will actually wait for a few hours and collect the orders from other retail investors. So that's several hours after 3 p.m., probably after market close. Then it will submit a net order to the fund. Right, so these accounts are called the omnibus accounts. So it's because intermediaries will collect the individual orders and net it out and submit a net order to the fund. So the fund doesn't even see the net flows until several hours after market close. Right, so they will strike the NAV first, and then they will see the net flows. So they can't, so, say they don't even see the net flows when they struck the NAV, let alone actually selling the bonds and the equities to meet the redemptions, right? So that's why, as a result, I will likely get out with 10, and then Deborah and Jen will bear all of that liquidation cost. Okay, and that causes strategic complementarity, right? So, when I withdraw, when some investors withdraw, the redemption price does not fully incorporate that liquidation cost. So the remaining investors bear all of it. And as a result, if they can anticipate that so if they can anticipate the transaction from me, they would opportunistically also leave to not bear that cost, right? Yes. So this is basically a diamond divot for mutual funds, but the important thing to note is this is mutual funds. It's not doesn't have to be deposits, right? As long as you have liquidity transformation, you can have this. Let me show some results. So it's very straightforward. So how are we going to show this? We're going to look at the cross section of bond mutual funds. Okay, so. And we're going to regress the flows to other investors, so subtracting the flows from the target allocation funds, and see how that co-moves with the flows from the target allocation funds. So the redemption induced trading summed up over the target allocation funds, right? So think about two otherwise near identical funds. One is surrounded by these target allocation funds. One is not. So when the equity market goes down, you know that investors in this fund will have a lot of redemptions from target allocation funds versus in the other fund, the investors know that they don't anticipate that. As a result, we will see more strategic runs from the first fund. I'll be brief on the results. So, you do this regression in the cross-section of bond funds. So when there's higher rebalance-induced trading, the other investors also redeem more. Okay, and then this is more significant. This is basically driven by the illiquid funds. This is where the liquidation costs are large, and then the strategic complementarity are supposed to be big, right? If it's a short-term treasury fund, there's no liquidation cost. You shouldn't see this. Okay, so a bunch of robustness, with different illiquidity measures. We can do subsample analysis, look at the government bond funds, this very liquid ones versus the high yield and international bond funds, very illiquid. Results apply. So we can look at all the samples, and then there's very little action with the positive rebalancing induced buys because there's no such thing as fire buys. So you don't have transaction costs there. And then it's concentrated in the negative RIT case and concentrated in the illiquid period for the illiquid bonds, right? That's where the liquidation costs are high. So I'm probably running out of time. Let me just zoom over a lot of the additional robustness. And then, so we have evidence using investor level data with equity induced rebalancing. So this measure is totally orthogonal to bond fund fundamentals. And let me just say, let me say this then. So if you use our cross-sectional regression results to estimate the runs in aggregate, the dark red bars shows you the actual redemptions from the target allocation funds. I just showed you that, so that's $60 billion in COVID. If you add the strategic runs, so that's another $30 billion during COVID. So if you sum them up, it's almost half of the outflows. All right, so I'm out of time. Let me just say one thing about we can use these quantities to have a back of the envelope calculation of what's the effect on aggregate stock bond correlation is. So just multiply the quantities with the price multipliers that we take from the literature. The black line shows you the aggregate stock bond correlation observed. So that has increased a lot over time. So the beta of treasury bonds have increased a lot. If we counterfactually subtract the returns due to the rebalancing trade, that goes down a lot, right? So in other words, these rebalancing trades explain about 17%. We don't claim to explain all of it, but you explain a meaningful amount of the stock bond correlation, right? All right, let me conclude. Sorry for going over time. So we document a new form of cross market fragility. Equity market declines leads to rebalancing out of the bond funds. That leads to strategic complementarity and strategic runs. And then this has implications, right? So it weakens the hedging role of the safe haven assets. And then lastly, let me just say that these dynamics will likely become even larger and more important future prices as the target allocation funds grow in size. Thank you very much. Look forward to Jonathan's discussion.
Thank you very much. This was a really fun paper to read through, and thank you for actually, that's those papers when you get some discussion requests and you're like, oh yeah, excellent, this will be good. So thank you. In reverse order, I'm going to end with making a few comments about the paper. In the middle, I'll do some coverage of sort of what the main results are, although I think Chuck did a really nice job. And then at the beginning, I will.
Sorry,
We're good? No.
changing the screen sharing.
Okay. And then I'll start by just following Bob's Hall advice and discussing this in the broader context of my own work. Which Chuck has already very nicely cited, but I'll frame at least how I came to thinking about this topic. And well, I'm not getting.
It's just click in the middle of the screen.
Perfect, thank you. Okay, so the broad question that we got into thinking about this is, where does market volatility come from? And there's kind of this work by Xavier and Ralph and others that thinks about the fact that there might be times when some individuals in a market decide to hold more or less of the risk in that market. In the models that we have, where basically assets are used to pool risks and then to allocate aggregate risks to the people who can bear them the most easily, in those models, if I take a few $billion, 10, 20, $50 billion and move it out or into the market, that should have trivial effects on the price. And the point of some of this work is no, actually those price responses seem to be quite substantial. And so I could have came from this a little bit from the household finance side, where I saw the rise of these target date funds, which have now become the dominant way in which American households save for retirement. So this is just a bunch of facts from a recent Vanguard report on how Americans save. It is now the case that in defined contribution plans in the United States, 96% offer target date funds, and 98% of those, the target date fund is the default investment vehicle. Most participants in U.S. retirement plans are using only the target date fund to save for retirement. So these are probably in your retirement plan, they're large funds, and what they are is cross asset class allocators. And so they pick a exposure to equities and exposure to bonds, international equities and international bonds, and they hold them roughly constant. And then they have a slow movement and adjust to the amount of aggregate risk that you bear as you approach and go through retirement. And what that means is that when the stock market does poorly, that fund has too little stock relative to bonds in its portfolio, and so it has to sell bonds and buy stocks. And so we kind of think of this as stabilizing asset classes a little bit and increasing the correlation between those returns on those asset classes in a very automated rule of thumb manner. So if the equity market booms, here in the figure, the target date funds are like, oops, we own too much equities relative to bonds. They sell equities, they buy bonds. And so the stock market boom suddenly gets a pushback, a bunch of target date funds selling, and the bond market gets this nice inflow of bond purchases. And I want to highlight something here. That's a stock market caused. What if this came from the bond market? What if there were a bunch of people selling bonds? Well, the target date funds are now liquidity providers. The bond market's going to go down. They're going to say, oops, we don't know enough bonds. They're going to sell these nice liquid equities and purchase bonds. So they're going to actually be decreasing systemic fragility. So this paper is all about what happens in COVID. The stock market crashes. There's this fragility now in the bond market that's transferred into the bond market. That is indeed an important side of the coin. There's another side of the coin, which is that if the problems happen in the bond market, target date funds are now asset market level stabilizers. So they're decreased fragility. So yes, I'm not undermining the paper at all. I'm just saying that there's two sides to the coin. Okay, so it's a market contrarian trading. And so when bad things happen in the equity market, oops, that's going to push over bad things into the bond market. But if bad things are happening in the bond market, then some of that ends up bad in the equity market, but it brings help from the equity market into the bond market. Good. Okay. And then this was kind of one of the point of our papers, and a little bit, this is just about the fact that on the left-hand side, we're going before the rise of these target date funds through the financial crisis. We have returns, excess returns on equity relative to bonds are the filled in squares, and the lines are equity market, retail fund flows into equity bond funds. And so the retail flows are in total, so the bonds are just total flows into equity funds. When the stock market does poorly, a bunch of money flows out of these funds. And when the stock market does well, a bunch of money flows in. On the right-hand side, we look at the same thing through COVID, and you see it's much flatter because the target date funds are now offsetting a lot of the fund flows. So this is interesting. So you think about what a bond fund thinks about when it thinks about how illiquid is the portfolio that I get to invest in. Right? Every bond fund manager likes to beat the bond index by buying illiquid bonds that count in their classification so that they can get a slightly higher rate of return and beat the index, which has to be based on the bonds that trade a lot that you can price. Well, if I'm owned by a target date fund, that's really neat because that looks like it stabilizes some of my funding flows. Right? So one half, it tends to stabilize. On the other half, and that's what I thought. This paper opens my eyes and says, but if the problems happen in the equity market, it actually destabilizes my funding. So I wish I'd read this paper a year or two ago. Yang and I have spent a couple of, on and off for a couple of years, been thinking about where does the rents to the stabilized funding show up in the financial plumbing system? And I think the answer partly is, well, it's a two-sided coin, and I've forgotten the other half of the side. So that's good. And then we track also, when an equity funds, target date funds are selling equities. They're pulling money out of particular equity funds. Those equity funds are holding particular stocks. You can trace it down to the stock level and look at the different shares to which a given stock is owned by target date funds. And we can see that they're controlling for a bunch of things that usually predict returns or generate returns, that the target date fund trading seems to have some price effect. So a stock that's owned a lot by target date funds is going to perform worse when the equity market booms and better when the equity market declines than an equivalent other stock. So that was kind of our paper. And also target date fund ownership in the equity market was very helpful during the COVID crisis for the reverse reason that the bond market was being hurt. That the equity market, the target date funds were an insurer. When the equity market went down, having a bunch of ownership by target date funds meant that I just lost mine.
Okay.
I don't think I touched. Sorry, maybe I did.
That's okay. Got it back.
Thank you.
Hide the controls. Please.
Okay, so again, there was just less volatile. The stocks that were owned primarily by target date funds had less volatile prices during the pandemic crisis. Good. And then there's a couple of other papers that Chuck referred to also. Adonov and co-authors show that actually international stock markets are kind of getting moved around quite a lot by US stock market performance because of the international equity holdings of these target date funds. And they even argue that there's some effect you can see in exchange rates from US stock market performance now leading to a lot of currency movements, not a lot, a little bit of currency movement, but a predictable point of currency movements. Harvey, Manzolini, and Maloney look at what we couldn't really get at, which is whether there's actually stock market wide return differences by not trying to track things down to individual funds, but actually thinking about there are a large number of funds out there. They either do things like returning to target date at the end of the quarter, or when they deviate a certain distance from their targets, constructing a time series of how much that should be going on and showing that that's actually correlated with returns and that it's front runnable. So you could actually trade ahead of some of these equity market predictable returns and make money in the equity market. This paper now says, oh, well, this is very interesting, Jonathan, but equity markets are kind of liquid and easy to trade in. Where this really might get interesting is bond markets. Bond markets have much more greater problem with liquidity. And so everyone's always worried about bond market liquidity. It's a natural and very smart thing to look at. And so the idea here is that they're going to broaden the approach to all target allocation funds. They're going to do some really nice additional data work. Again, as Chuck referred to, they're going to measure a little bit better the changes than we did, taking international equity returns and the like all very seriously. And then they're going to zoom in on the COVID period because there's this really big, interesting shock, which is kind of this one-off shock where the equity market crashes, and this leads to this huge disruption in the bond market. One small comment is that there is, if you look at the figures that Chuck presented, there's one real outlier, and that is that one bond market crash. And so they're going to call that asymmetry. I think that's probably right. But there's nothing on the upside that really looks comparable. The upside movements are relatively smaller. So it might be something to do with the size, but I don't think so. It's reasonable interpretation they give to. The key result is that other investors are going to amplify the selling of these target allocation funds for the most illiquid bond funds, and they're only going to amplify the sell side, not the buy side. And so the big point here is that not only are these target allocation funds creating co-movements between equity and bond markets, but on the bond side, they're facing some liquidity challenges, and smart investors are getting ahead of the bond trading that they're doing and making the bond market disruptions slightly larger. Okay, now the way I would frame the evidence is there's no eyewitness, but there's a lot of circumstantial evidence that points to this going on. Okay, so that's the way I want to think about it, and that contributes to bond market fragility. Okay, so the main results a little more specifically in the paper, and I'll try and just do this slide very quickly because I think Chuck did very nicely. The target allocation fund rebalancing trades are highly predictable from what they're owning and from the various performance of the funds that they hold. So you can look at the portfolio that a mutual fund holds in terms of the underlying mutual funds, QSIP by QSIP, you construct, okay, here's what's exactly happened to their equity, here's exactly what's happened to the bond, here's what they need to do, and that predicts very well what they actually do. Then the results. The target allocation funds tend to sell less bonds than they're required when they're selling. This is more pronounced for illiquid funds and when spreads are overall higher, meaning that's more costly to be liquidating in terms of bid-ask spreads. And it doesn't really appear as much if you're holding a fund in the same fund family. Now, this is surprising to me, and I have two slight questions about this. One is in the target date fund world, as Chuck showed, Vanguard target date funds hold all Vanguard underlying funds. The same in Fidelity, the same in BlackRock. They all hold their own. So who is it out there who's holding? I have a target allocation fund, and I'm happily holding mutual funds from other providers rather than my own. Most of the top-level sales tend to flow down to the same company's funds. So that's question number one. Secondly, so I'm not sure that there's that much variation. Secondly, who's kind of driving that? If I talk to the target date fund managers at the large asset management companies, they claim that they act independently and pick whatever funds they want to have in the underlying funds. And if they want to switch across funds, they just do. But somebody is somehow getting some pushback and doing a little bit less trading there. So I'm curious about where that comes from. But nonetheless, that sounds exactly like the target date fund worrying about these liquidity problems and leaning and knowing they're bearing these costs and steering against it. And then the kind of the main smoking gun here for the externality or the run part is that the formulaic target allocation fund redemptions, the ones that really follow these rules, are associated with more redemptions by non-target allocation funds. And this is not typical retail investors. This is tracking somewhat sophisticated insurers and other large institutions where they can see what they're holding in their funds. And so again, this happens mostly in illiquid periods and mostly for bond funds that have higher spreads. And so that seems exactly consistent with this idea that, oops, I know that the target date funds are going to sell a bunch of these. I want to get out beforehand so I don't bear the price that's of the illiquid. You could think of this a little bit as a fire sale. Chuck sort of leaned against that in the presentation. It could just be bid-ask spreads that could be significant. And then the last result is that these target allocation funds increase the correlation between the two markets, the stock and the bond market, and change the volatility of each. Some comments just to run through quickly before I conclude. So one concern might be that these people that are running along with the target allocation funds, are they just closet target allocation funds, maybe slightly faster to act? We know there's a lot of other money in the market, which is model portfolios, for example. If I was a high net worth investor, I could hand my money to a Fidelity brokerage account and say, automate these trading rules for me, even though it's not in a fund, so that I always have a whatever it is equity share. Here, I think the within fund evidence leans against that interpretation, that it's actually not just people who are moving along in the same way, they're actually running. But that's across liquid versus illiquid, fund family, non-fundly sort of results that point that direction. So it's not super solid, but it seems reasonable. The second comment is about the use of derivatives. So at Vanguard, the Vanguard Target Date Fund hits its target allocations every single day at close. And they may have a very large inflows and outflows. And how do they do that? They do that partly with the use of derivatives. So they'll just buy bond index and sell bond index derivatives. And so they can take a while before they actually need to sell or buy the bonds. Now, somebody has to hedge that bond. That could be net neutral, but otherwise there's a bank synthesizing and selling that hedge. In that case, they're buying and selling a bunch of bonds, but it may not have quite the same pattern as the bonds that they're tracking through their experiment. So that's just noise in their experiment, but it does kind of matter a little bit for the quantities and magnitude, for the magnitudes potentially. Let's take, if I look at Fidelity instead, Fidelity doesn't try to hit, it's a much more of an active target date fund. Here's our target, we have a 60% equity share, but if it drifts 5% above that or 5% below that, and we think that's reasonable to be there because of our forecasts of what's going to happen with returns, then we'll actually let that happen. And so they actually are a little bit active. They aren't as rule-based, consistent with the difference between Fidelity and Vanguard. They will also say, you know what else we're going to do? And Vanguard will do this to some extent too. When we get more inflows, we're just going to allocate them to the asset class that we're short on. So we're actually not selling. And what we'll deal with is just in the derivative market, making sure that our targets are close to met or where we want to be, so that they can save on transaction costs by reallocating inflows rather than outflows. And that's actually going to differ across the age of the bond fund. So it's our target date fund. So target date funds that are around the target date or after often have a lot of outflows. Young target date funds probably have a lot of inflows. And so if you look at inflows versus outflows on them, you might get a sense as to which ones might be doing this and which ones aren't. It might be another aspect of heterogeneity that you could look at to bolster your story. In our world, when we looked at target date funds with different shares in equities, they have different amounts they're supposed to trade. So if I'm 50-50 and the equity market moves, I've got to do a lot more trading than if I'm 100% equity, then I don't have to do trading at all. 95% I do a little bit. And on our equity side, everything lined up perfectly. So when I said the 50-50 guys are doing a lot of rebalancing, there's a red line, which is in theory, and the blue line, which is in the data. In the bond funds, we did very poorly, or relatively poorly. And so we wrote that down to derivatives.
Maybe, maybe not. Another alternative is we didn't do this, bond fund by fund. We used just asset class returns to decide what the trading should be. And there might be a lot more heterogeneity in which bond funds, what they hold. Actually, there is. So I now know there's a bunch more. We've been looking at this a little bit ourselves. So probably this is about your better measure rather than the use of derivatives, but you could show pictures a little bit like this to convince me of that. But I think you're probably actually just doing a better job of measuring. There's a little bit of ambiguity in the paper between whether this is really front running or predatory trading versus the Diamond Dybvig, which I think of Diamond Dybvig as partly a general equilibrium point, not just a game theory model of a bank run. So I don't love the use of, Itai is more knowledgeable than I am, but I think of this as a classic bank run versus just predatory trading. And to what extent do we really care? It's the similar disruptions, the similar overshooting in price. And I'm not sure that I wouldn't go all the one way versus the other. And if you can give me more evidence to convince me that it's one or the other, I would be interested. Comment 4 I've already made. That to some extent, this is a stabilizing force going the other direction. I'd like to see where the bond funds run to when they run a little bit, and where the runners, when I run along with a bond fund and I sell the bond fund, where's that money going into, and what is it stabilizing in some sense? Who's getting the benefits? And then I give more of a range for the stock bond correlation, but those last two they're just kind of small points. So it's a really interesting and well done paper. The simple rule-based rebalancing you see by target allocation funds is growing in importance. We argued that this was a stabilizing force. When there's a big move in one market, it makes both markets absorb that move. This paper says, hey, what about bond markets? Bond markets actually could really suffer when the equity market troubles feed into the bond market rapidly. And I think it's got a really nice evidence that sort of this front running or a bank run type feature means that there's a bunch of other traders that actually amplify the problems that the equity market then feeds into the bond market here. And so there's this tension between having retail investors who are linking about liquidity and think they have liquidity, have a large share of their portfolio in illiquid markets through instruments that are now trading actively on their behalf. And that creates a fundamental friction, which this paper is really nice at showing us one of the costs of. Thank you very much.
The authors in the discussion have conspired. They ran in the same direction. So we have like 30 seconds. And what is this like? Do not respond. Just let someone in the audience say something. Usually I leave 15 minutes for comments. Not okay. Suffering over here. If anyone wants to say something, okay, you get to say something and then I'm
It's on. Yeah. Extremely interesting. Thanks a lot, Chuck and Itai. So I want to follow up a little bit on a point made by the discussion, if it is predatory versus this is complementary, right? And I was thinking there the old papers about the big investor in banks or, the Soros papers in currency attacks, whether you could exploit a little bit the size of these target funds versus other investors to understand versus if the composition of investors matter for these incentives. My intuition says that if the target fund is big relative to the bond fund, they may have a more stabilizing force on a diff in diff. So probably, I don't know if you could do something to disentangle these things. It's very interesting. Thanks.
Yeah. So you said you should not respond.
Well, no, I did not discuss it. Go ahead. Not to Jonathan.
Yeah, right. In previous papers about fund fragility and strategic complementarities, we did more to kind of tease out the mechanism with the composition of investors, for example. So that's certainly something we could explore here as well. That's a good point.
Sorry, I don't like this job, but it's time for the next paper. And
all right. Well, they come up.
Have a very good conversation at dinner. So.
Yeah, we can talk about it at dinner too. The thing. Could you just mention your result on fund families? Like how much of an effect gets absorbed by the fund families. But you should go ahead and get your slides ready.
Yeah, while you're getting.
While you're answering.
Yeah, that's good question. I wondered about that too.
Take that one. Here's a number, right? So usually it's 1-for-1. The most illiquid funds, so like if I have 5 bond funds and I should rebalance them equally, the most illiquid funds I only do 0.8. I do 80 cents. Yeah, so if that helps.
They lean against it.
Oh yeah, because it's costly.
Right. Thanks very much, guys.
Sorry for going there.
Okay, great. Well, thanks to Debbie and Jan for putting this paper on the program, and for everyone that's missing the France-Spain game. It's 1-0 Spain. So this is the deposit franchise and the risk-taking channel of monetary policy. It's joint work with Ricardo at the Fed and Xiang, who's here, my colleague at Imperial. Okay, so why don't we jump in? I'll try and stay on time. So what's the big picture? Well, we typically think of monetary policy as having effects on financial stability. And one way in which it does so is through bank behavior, right? Within that space, people think about the risk-taking channel of monetary policy as being key. When we change interest rates, it changes banks' incentives to take credit risk. Rates go up and bank risk-taking goes down. And these risk-taking incentives typically depend on banks' skin in the game. And when we're thinking about skin in the game, we're typically thinking about the role of bank capital, right? That's the kind of equity buffer that banks have at risk when lending losses materialize. The existing risk-taking channel focuses on that specific capital as the key source of heterogeneity. So what they look at is when there's interest rate changes, how do banks with a high capital ratio relative to a low capital ratio change their risk-taking behavior? We're going to suggest an additional form of skin in the game, which we're going to think of as the deposit franchise. And these are going to be rents that are valuable future profits banks earn that could be lost in distress. Okay, and recent work has already shown that this deposit franchise can be very important for monetary transmission and bank lending. So when you kind of put those two things together, it makes you think maybe the deposit market structure directly shapes the financial stability effects of monetary policy. And so to say that more precisely, the question we're going to ask in this paper is, does the deposit franchise shape the risk-taking channel of monetary policy? We'll have a kind of simple model in which we're going to link monetary policy, the deposit franchise, and risk-taking. What we're going to show in the model is banks with a stronger deposit franchise raise deposit rates less when the policy rate rises. Most of us will have deposit accounts, and we'll see that our deposit rates are usually not very good. Even as finance professors, we probably don't shift as much as perhaps we should. And so they're going to see large increases in deposit spreads. That's going to give them more deposit profitability and generate the skin in the game that we're talking about. And so the model is going to predict that banks with a stronger deposit franchise reduce risk-taking more in response to higher rates. Then on the empirics, which is going to be kind of the meat of the paper, we're going to try and directly test this mechanism with supervisory loan level data from the Y14 from the Fed. And I did forget the Fed disclaimer, but you know, that always applies when there's a Fed co-author. So we're going to look at monetary policy shocks interacted with banks' predetermined deposit betas, which we're going to think of as their exposure to the deposit franchise. We're going to attempt to control for credit demand with borrower time fixed effects, despite kind of the debate earlier this morning in the corporate finance session. And then we're going to, consistent with our model, find that banks with lower deposit betas are going to cut risk more aggressively following rate hikes. So in the paper, we're going to try and make, I think, what's a simple point, is to formalize and test a new mechanism for the risk-taking channel of monetary policy, driven by endogenous bank incentives to protect the deposit franchise. And so the implication being that this deposit market structure is going to influence the financial stability effects of monetary policy. So let's jump to the model. The model is kind of intentionally simple in this presentation, and we have some extensions in the paper. So imagine banks' deposit rates are going to be lower than the policy rate. RD is the deposit rate, R is the policy rate, and beta is going to be this exogenous bank deposit beta. In the paper, we have an endogenized version, but for now, just think of it between 0 and 1. If it's 1, you have perfect pass-through from the policy rate to the deposit rate, and if it's 0, you have no pass-through.
So we're going to assume that deposit spread is positive because of that. And so what's the problem the bank's going to solve? It's going to solve a profit maximization problem, and it's going to choose credit risk. Credit risk is theta, and it's choosing how much risk to take by trading off the fact that higher risk generates a higher profit margin. It's theta I plus R minus RD, but it's going to be at the cost of higher default risk, right? I take too much risk, I get a nice return now, but I might default. And so that's going to be governed by the survival probability P of theta, which has the standard regularity conditions. Okay, so from that simple model alone, we get two nice predictions. The first prediction is this risk-taking channel. Banks with a positive deposit franchise take on less risk following increases in the policy rate. Okay, the intuition being kind of loosely, rates go up, your deposit spread rises, your profits rise, you decrease your risk to preserve that franchise. That's kind of a standard result in terms of the risk-taking literature, rates go up and risk goes down. The kind of more novel feature here is we get this cross-partial result. Banks with lower deposit betas, so less pass-through, stronger franchise, reduce risk more strongly when rates increase. Okay, again, loosely the intuition, rates go up, the deposit spread rises more for a bank with low beta, and so they want to reduce their risk more. And I kind of say this loosely speaking because we can take it to a kind of present value perspective. If we imagine that that static problem is repeated for an infinite number of periods, we get this nice optimality condition. And I'm going to talk mostly about the chart, but the math is just on the side. So the purple line, what you see is the marginal gain from risk taking. Right? As I increase risk taking, the marginal gain's declining. That was governed by the probability function. And then I have two marginal cost curves. Cost curve for a low beta bank and the cost curve for a high beta bank. And what do we see? The low beta bank is steeper. And so what happens when rates go up? The marginal gain from risk taking is going down because it's discounted at a higher rate. And what we actually see is that the risk for a low beta bank falls more than the risk for a high beta. Okay, that's kind of what we're getting at. We're just basically saying the low beta bank has a higher level of franchise to lose when the rates go up. Okay, so we're now going to try and test this. I'll say some brief comments about the data, but it's the Y14 data from the Fed, covers large bank holding companies from 2015 to 2026, captures around 2/3 of all bank C&I lending. The structure is kind of nice. It has multiple loans per borrower across banks and time. And we're going to have a few key variables of interest that I'm going to speak much more about later. But at the loan level, we have measures of riskiness. Right, so for each loan, we're going to have a bank measure of ex-ante probability of default, and say ex-ante time of origination, ex-ante expected loss, and then two ex-post measures of loan performance. We're going to have other loan characteristics like loan size, collateral, interest rate, and so forth. And then the bank level measures are kind of the standard measures. So the key features to take away from this data set that we're using is this ex-ante loan level risk taking, which is going to be measured using banks' internal estimates of probability of default, borrower time fixed effects because of this structure of the data, and we're going to be able to estimate dynamic responses. So what do we do empirically? First, we just make sure that kind of prediction one holds, which is, does the standard risk-taking channel of monetary policy hold in our data? That is to say, when we raise rates, do we see risk go down? To estimate that, we're going to estimate a standard local projection, where we're going to put as the outcome variable the probability of default for loan K by bank I. And on the right-hand side, we're going to just use a monetary policy shocks from Jarochinsky-Karate. Okay. And so the impulse response function I'm going to show you on the next slide is just going to be the sequence of those betas, which are going to trace out the response of probability of default at time t plus h to a shock at time t. Okay, and what do we find? We confirm the model prediction, and it's very consistent with the findings in the literature that rates go up and risk-taking goes down by banks. The magnitude is economically meaningful. It reflects around a 25% decline in credit risk, ex-ante credit risk. The more interesting part is the role of the deposit franchise. Right, so here the prediction is banks with stronger deposit franchises reduce risk more when rates rise. Okay, so our framework suggests using the deposit beta as kind of the exposure to the deposit franchise, which is how much does a bank raise deposit rates when the Fed raises rates. And so we're going to compute that deposit beta following DSS and estimate it over a pre-period 1984 to 2014, right? Remember, our sample estimation is 2015 onwards. And so kind of important for our identification is that these deposit betas are predetermined relative to our sample. And those predetermined betas are going to strongly predict in-sample betas. Bank level and loan level balance across high and low deposit betas is going to be pretty reasonable. And then I kind of have a third validation check, which suggests these predetermined betas also predict in-sample deposit profitability. I'm just going to show the first two in the interest of time, but I can show the third if we have time in the Q&A. So do the pre-period betas predict in-sample pass-through? X-axis is the deposit beta between 84 and 2014. The y-axis is between 2015 and 2026. So we find they very, very strongly predict, even nicer than we'd expected. And so that kind of gives us a reasonable source of validation for that. On the second, I'm going to show you kind of the balance across high beta and low beta banks, both at the bank level and at the loan level. At the bank level, obviously, the betas are different because that's what we've sorted on. And the deposit shares are slightly different as well, as we might expect as they follow the beta. But what's interesting is the capital ratio, leverage ratio, and profitability as measured by return on assets are very, very similar. The size is a little different, though statistically not too different. And at the loan level, there isn't really any meaningful statistical difference between a high beta and a low beta bank on average. Okay, so kind of with those validations aside, let's kind of see how we can test this. We're going to use, again, the same specification we used before, just going to add an interaction. Right, we're going to interact the shock, the monetary policy shock we use, the Jarotinsky-Kurati one, with our predetermined deposit beta. And because of our new specification, we can also incorporate borrow time fixed effects to help control for credit demand. We're also going to be robust to borrower bank fixed effects as well, and we'll show that in some tables later. And our prediction, if you recall, is that this lambda, the interaction coefficient, is going to be positive. Right? Banks with a weaker franchise are going to reduce risk less in response to fix, right? So everyone reduces risk, the weaker franchises will reduce it less. So lambda is positive. What do we see? We do indeed see that risk-taking falls less for banks with a higher deposit beta. It's consistent with our model prediction. The results kind of robust across trimmed and untrimmed samples of PD, which is kind of a noisy measure. And at this point, you might kind of ask, well, you know, it could be that I'm reducing my probability of default, but really increasing the loan size. So my actual exposures might have gone worse. And so maybe we need a measure of expected loss rather than just probability of default. So in other words, quantities also matter. And what's nice about the data is not only do we have probability of default for each loan, we have the loss given default and the exposure at default. So we can construct an ex-ante measure of expected loss at the time of origination for each of these loans and redo the exercise. And we find exactly the same pattern, right? What we see is expected loss also falls for banks with a higher deposit beta, consistent with our probability of default results. And so for this, we kind of take away that the ex-ante risk-taking is falling less for high beta banks, as our model predicts. Now, if you're kind of a little bit skeptical, it might be because all of these measures are based on banks' internal models, right? Banks have discretion in how they determine that probability of default. And you know, while I trust the Fed supervisors, some of you may not. So can we check how reliable these PD estimates are? And so what we're going to do is we're going to just predict ex post loan performance using ex ante bank risk measures, right? So I'm going to look at what the bank's ex ante measure of probability of default is on a loan, as well as its expected loss. And I'm going to see if it predicts two measures of loan performance, loans, the number of days the loan is past due, as well as the charge-offs. And what we find is that actually these internal bank risk measures strongly predict subsequent loan performance. And if, you know, we can discuss this in the Q&A if we want, but a stricter test would be, does loan performance deteriorate more for high beta banks post-tightening shock, which is to say, putting in these outcome variables into our previous specifications, we still also get similar results. Okay. So now, one thing we were kind of grappling with is how does this compare to the existing mechanisms? Many of the mechanisms in the literature, search for yield and moral hazard, indicate it's banks' capital that really matters. That's a key driver of risk-taking responses. And so we're going to just do a very simple horse race, interacting kind of the shock and the deposit beta, as well as the shock and the capital ratio. And just to kind of show you what happens, both mechanisms seem to exist. after rate hikes, banks with higher capital ratios reduce risk more. This is kind of Delariccia's JF paper. That's what we find as well. Our deposit channel seems to get a little bit stronger. Should say that both the capital ratio and the deposit beta are standardized for one standard deviation. And so it seems, at least in this, that the impact is larger from a standard deviation change in the deposit beta than the capital ratio. Okay. And then one kind of point that we thought was really interesting to think about was, so far the analysis is based on the loan book. Okay. What the data allows us to do is look at also loan originations. And that's typically what the risk-taking literature does. It starts with the entire loan book, and then it shows that the loan originations is the real margin. And so we're kind of following in similar footsteps. And what we're going to do is we're going to run the same type of regressions. And I'm going to show you how PD in columns 1 and 2 and expected losses in columns 3 and 4 respond to a shock to a monetary policy shock interacted with the deposit beta. And so what do we find? The results are actually very consistent with prior analysis, right? They're actually a bit larger, I guess meaningfully so, which is what we'd expect, right? It's the case that the margin you can most adjust on is on new loans, so you would expect most of the risk-taking change to be in that. We have the standard controls, as well as in kind of the even columns, borrower times bank fixed effects. One kind of additional feature that I think is very interesting to think about here is, with these borrower time fixed effects, we're thinking of the same borrower borrowing from two different banks at the same time, right? And we've hopefully convinced you that isn't much manipulation. So how is it the case that one borrower borrowing from two different banks at the same time is getting different risk profiles? And so what we do is we think about what are the contract features of those loans that could allow for this. And so we're going to do two things. We're going to look at whether collateral on the loans differ and whether the loans are more or less likely to be first lien. Right? And so on the first one, what do we find? We find that the banks that are higher deposit beta are less likely to require collateral. Right? That's very consistent with the fact that they're going to have a higher PD. And then we do the same for seniority. Right? So this is just, they're both just dummies. Collateral's a dummy if there's goes 1 if there's collateral, and seniority if it's a first lien loan, first lien charge. And we find again the same thing, right? A bank with a higher beta is less likely to be senior. So what we think this tells us is it kind of goes beyond just documenting there is this difference in PD and trying to highlight the margin that banks are able to adjust on new loans. And for us, at least in our data, it seems to be that loan collateral and seniority appear to be relevant margins of adjustment within borrower. Okay, and then there's kind of one other thing we were thinking about, which is you could imagine a world in which there's bank-specific loan demand that even borrower time fixed effects won't solve. We kind of hope borrower by bank fixed effects deals with this, but we also do another exercise where we look at loans by a different purpose. So, whether it's CapEx, working capital, M&A, and so forth, and we rank them by how risky they are. And then we see whether there's a difference. Are low beta banks and high beta banks doing different purpose loans, risky purpose versus non-risky purpose? And is that driving the results? There doesn't seem to be much of a difference in purpose. So we kind of think it's not driven by bank-specific loan demand. So then just to conclude, and I'll be right on time, I think, we study how deposit franchise shapes the risk-taking channel of monetary policy. We have a very simple model, many extensions in the paper, that links monetary policy, deposit franchise, and risk-taking. It's well known about franchise disciplining risk-taking. That's kind of an old insight. We're adding to that in terms of connecting it with monetary policy. And we have simple predictions. Predict that banks with a stronger franchise respond to hikes by reducing risk more. And then we spend quite a lot of time trying to test this empirically with the Y14 data, find very robust heterogeneity in risk response across banks with different deposit betas. Mechanism coexists with existing mechanisms that are highlighted in the literature, the bank capital ones in particular. And our analysis of new loans, I think, suggests that loan collateral and seniority appear to be relevant margins of adjustment. The key implication kind of being how monetary policy transmits to financial stability depends on a bank's incentives to protect its deposit franchise. Great, thank you.
Okay, thanks for having me here. Cool paper, obviously interesting topic, so I'm not going to say any more about that. There's sort of two things running through this paper. So here's what I'm going to do. I'm going to walk you through the paper. I'm actually going to use fairly different language than was presented. It's the same paper, I'll just say it differently. And then along the way, I'll raise some questions that came up to me as I was reading through this paper. So there's two underlying hypotheses in this paper. The first one is sort of an old idea, which is the deposit franchise acts as skin in the game concerning bank risk taking. Lots of work on that. That's buried in this paper as well. And then the second idea, which is sort of the novel, interesting idea that the paper is playing with, is there is a literature which shows that when the Fed, say, lowers interest rates, bank response to it looks like a change, not just in the price of credit, but the price of credit risk. So the sort of risk taking going on. And the way I think about that is Fed lowers interest rates, a bunch of borrowers show up at banks. They all ask for a loan, and the banks say, we want the risky one. So it's sort of a portfolio shift on who it is that the bank is lending to, which is really, I think, in my mind, the key result of the paper is that very last slide that Ali showed us, which is new loans. Banks make the loans, they're making higher PD loans, they're taking less collateral and less seniority. That's sort of the central result of the paper. Okay, so these two hypotheses, it's worth thinking through both of them in this context, and that's, as I said, that's how I'm going to talk you through this. So start off with if you want, the simple hypothesis, which is deposit franchise affecting risk taking. That's my model of a bank. Deposits pay less than the market rate, beta R less than the market rate. There's a deposit franchise. What is that? It's the present value of the stream of sub-market rates that the bank is paying on deposits. That has some value. And if you go to a bank that has a deposit franchise and you say, here, would you like to make this new loan? It has some expected return R, in which the risk characteristics of that loan are measured by theta. The bank will say, the expected return high. If theta is high, I get a higher expected return. But if I take a more risky loan, maybe the whole thing blows up, and P prime of theta, the probability of the whole bank defaulting, goes up, in which case I lose the entire deposit franchise. So that's the first order condition. That's the model that Ali showed you. And to the extent that you have a deposit franchise, that PV is a large thing, it's going to temper your willingness to take a risk return trade-off. Again, this is the standard deposit franchise. Okay, just some things to think about when you put that on the table. First, there's a loan franchise. It's not just a deposit franchise. And what should be in that PV is not just the deposit franchise. It should be sort of, in a sense, all of the rents associated with running the bank. There's a nice RFS paper by Egan, Llewellyn Sundaram, which says, roughly speaking, it looks like the deposit franchise is 2/3 of the franchise value of the banks. So, first pass, this seems okay. We're mostly focused on the deposit franchise. That's most of the franchise value in the bank. And so we can kind of go with that and think through this mechanism that they're putting on the table. The second thing that immediately pops out is deposit insurance. P prime of theta is I take a more risky loan and the whole thing blows up. But if the whole thing is insured, then it doesn't blow up. So there should be some gradation in how we think about the value of the deposit franchise and how runnable it is from the standpoint of adding one more bit of risk into the bank's balance sheet. All right, so that almost suggests another cut of the data that you're doing based upon the type of deposits that we're looking at. Second related point, aggregate versus systematic versus diversifiable risk, right? If I take on this P prime of theta is really systematic risk, right? I take on a ton of subprime mortgage-backed securities and the whole thing blows up at once. It's not really about diversifiable risk. So that's also suggests a cut of the data one should be using when you think about your PDs on what type of new loans I'm originating. All right, so you could test this deposit franchise mechanism. Just as I said, I'm not even talking about monetary policy, just test the deposit franchise mechanism. That's the first order condition. And a way of testing this would be to say split banks into the size of the deposit franchise and ask simply the question, are their portfolios systematically biased towards different risk categories of loans? That's one thing you could look at, but really the portfolio choice model of the bank is not just about risk, it's about a broader set of things. And so to the extent that deposit franchise tempers risk taking, it should in principle also affect other things like your security position. Are you changing the duration of your security position systematically if your deposit franchise is different? I could also imagine it will change your liability structure. Like if you do have a big deposit franchise, maybe you should arrange your deposit franchise in a way that most of your liabilities are coming from insured deposits, which are less runnable. So again, that suggests that there's a broader set of things one should look at if you think that deposit franchise affects portfolio choice, again, in the broad sense of what a bank is doing. So you could run regressions like this. Immediately, if you run regressions like this, a whole bunch of people will raise their hand and say, no, deposit franchise is endogenous to the portfolio choice and too many other things. Who knows what's going on? So don't run this regression. So don't run this regression, run a different regression, right? The way I think that the regression you're running right now, I think of it as a shift share design, right? And you don't use this language, but that's kind of the way I think about what you're doing. What you're really doing is you're saying that I can split banks based upon their deposit franchise. That's the share variable. And you showed us that it is predetermined and predicts the betas during your sample. So I've got that thing fixed. I split the banks. The shift is the monetary policy shock. So I shift the monetary policy shock. So I've got these banks. They have different shares, different deposit franchise. The Fed comes and lowers rates unexpectedly. A whole bunch of borrowers walk into the bank, and then the question is, do these banks choose different ones of these borrowers, right? Again, the prevailing view in the monetary policy risk-taking literature is all the borrowers show up, and you say, give me the risky borrower. The deposit franchise model says all the borrowers show up. The bank with a low deposit franchise says, I don't have anything to lose. I'm taking the risky borrower relative to the bank with the high deposit franchise who says, please give me the safe borrower, right? So that's effectively what's being asked here. Now, there's an issue, which is, I think, and I'm not an econometrician or I'm not deep in identification, but there's an issue that immediately pops up, which is your shock changes the shift variable, right? The deposit franchise itself depends upon interest rates. So I think strictly, there are other people here who can speak more about this than I do, but you need your shift you need your share variable to be unaffected by the shock. And I don't think that's true in this case. You need to put some more structure on this to make this true. This is fundamentally questions about the duration of the deposit franchise. And I would say you could cite us and say, the duration is slightly positive, but close to zero. But there's like open questions, and you probably need to take a stand on exactly how the shock itself changes the deposit franchise before you go out and run this regression. Okay, so put some structure on that. The second thing that I was unsure of, so the theory says, I've got these two banks with different deposit franchise. I treat them with this monetary policy shock. A whole bunch of borrowers walk in. And what I should expect to see is that the bank with the low deposit franchise will pick the high risk borrower. This is the regression that's run on the bottom line. And so I'm looking for high franchise banks taking on less risk. I think the answer, it's less risk relative to low franchise banks. The regression has a bank fixed effect, which means what you're really doing is you're comparing what the bank on average does to what the bank does when the Fed lowers interest rates. You're also comparing it across banks. At this point, I've sort of lost the, I've triple difference too many things out, and I don't know what's being estimated at this point, right? But I think that the theory is very clear. I have two banks with different franchises. I hit them with a shock, and I want to see the bank with the low franchise choose higher risk borrowers. That suggests a set of controls which I don't think are exactly the ones you have going on. So some cleanup here I feel is needed. Okay, and then this is sort of an obvious point, but I would like to see more on this. You sort of kicked it out and said it doesn't matter. There's like this basic question, which is the deposit franchise correlated with something else, right? Again, we have this variable, high franchise, low franchise. We hit the shock monetary policy, and then we see, do they take different risk loans? Well, that last item here, you sort of dismissed it, but total assets are different. I have looked at this deposit beta literature. There's more dimensions in which banks are different. Like there's large banks versus small banks, which have systematically different betas. In the world today, we have these online banks versus non-online banks. There's many dimensions in which I don't think you can as easily dismiss that my low beta and my high beta banks are the same banks. It's implausible. And if that's not true, then surely there's another mechanism in which this channel is working through. Now, in principle, that's okay, right? Like at heart, what you're talking about is a risk-taking channel, and you have some characteristic of a bank which correlates with deposit beta, and you're telling me that characteristic helps to explain this risk-taking channel. So in a very broad sense, I'm totally happy with this, but in the very specific sense that it is due to the deposit franchise, which is then connected to the broader banking literature about the deposit channel, I would ask you to sort of step back. Okay, so I'm done actually, Debbie, early. There's a new fact here. It's figure 4, and it's that last table, and it's fundamentally this thing where interest rates change. We have differential behavior of these sorted high deposit beta, low deposit beta banks, particularly in their new loans. That speaks to the risk take channel. I would like to probe this much further. I'm at this point not willing to give you 2 thumbs up on, I believe this result, I suspect it's true, but I feel like you need to do a bit more work before you convince me. Thanks.
Well, yeah, thanks to Arvind for a very nice discussion, very thoughtful. So, I totally agree with basically all the points. And so first on loan franchise and deposit insurance, that's sort of things that we're planning on doing actually with some further extensions and robustness checks. And we don't have them yet, but hopefully we'll have them in future version. And for the testing the first hypothesis, that's actually how this project started. When I was a third-year PhD, I had another paper that's exactly testing the first mechanism, but I was just naively regressing risk-weighted asset to capital ratio on betas, and I did run into the problem that Arvind forecasted, and that paper didn't get published. So that's here we are testing this with loan level data and then on the monetary policy changes. So on the fixed effect, so yeah, we think it's relative to low beta banks versus high beta banks. So we have borrowed time fixed effect, so it's within a firm, and we compare banks that have high franchise and weak franchise, and we think of the bank fixed effect as just like a control on fixed bank characteristics, but hopefully more or less standard. Yeah, do you have anything to add?
Yeah, I'll say a couple of things and then we can quickly go to questions. On your kind of point that the deposit franchise is endogenous in response to the shock, that's precisely why we do the predetermined one and why we do the validation. I see you shaking your head. But that's kind of, we try and hold it fixed and we say it still predicts in the sample. I think that's as much as we can.
You need it not to change.
It's true. So we have the pre-estimated, but I think the concern is that the franchise value corresponded to the beta can still change with the shock. So I think at first I would have to say that although it can change, but cross-sectionally it still doesn't change the ranking. That's the first thing. So hopefully as the qualitative effect it's still there. And yes, then your papers on the duration can help us.
Yeah, so we were also planning to do it, I guess, looking at long-term security of the share of assets and interacting that with our measures to see what we find. I think we updated the paper before it. We did actually use all the shift share lingo, and then we removed it. So it's interesting that you brought that up. I don't know which stance to take on that, but yeah. Great questions.
First want to bring up an institutional background. The probability of default is not an action, but rather a report. So you interpret it as if a falling PD is the banks choose safer banks. That is a risk-taking channel. But there could be totally another one is there's nothing change on the loan book, but the banks recalibrate their models more aggressively. In that way, the PD can also change because that model is changing all the time and it varies across the banks. So this can confound your findings, something model away. Second, I want to bring your attention to some other reference. You're showing franchise value affect reallocation of monetary policy. This topic has, as echoing Arvin's talk, banks are different in many ways, like Itai's paper showing the universal bank. If you have a non-bank financial institution subsidiaries, they're also affecting the monetary policy. Like our paper showing if you have internal loans from the bank holding company, that also affecting the monetary policy. So I wonder how you can cross out that alternative explanation. Thank you.
I can start on the PD one. So I think that's a fair point, and I would think we do as much as we can to deal with the possibility that there's a lot of bank level discretion in the PDs by showing that it still predicts, both within our specification and just in general. PD predicts loan defaults or ex post loan defaults as well as loans past due. If there was really substantial manipulation, we would expect the prediction not to be very strong. And then on the second, the bank difference, and I think that was Arvin's comment on the balance tables as well. The Y14 only for us has 29 big bank holding companies, right? So we're not going to get all these really, really small banks. The cost of that is we have a much smaller set of cross-sectional variation to work with, but that's just what the data is, and I don't think there's much we can do about it.
Run it down there a few questions.
That is a very good paper. I was wondering if you actually checked some asymmetry on interest rate on when we can check when with positive shocks and negative shock. That was even better when with the momentum of the interest rate, right? Because there's a whole literature that when interest rates going down, the monetary policy is more effective than when going up because people just refinance their mortgage, right? And related to that, so even though you do have the monetary policy shock, like a very big part of your sample is the zero lower bound since 2008, the rate's really not changing at all, right? So if you guys have some exercise by excluding the zero lower bound as well.
So the
Take a few more.
yeah. Oh.
Itai, I guess.
I was wondering why you go all the way to the risk-taking channel. You could just look at the bank lending channel at a more basic level and see what happens to bank loans as a result of monetary policy. It seems like there's an important missing step, and you just jump. And this will also help address Jenny's.
We'll take one more on this.
Thanks. I think that's a great paper. I have more of a suggestion rather than a question. So here, the risk-taking data is sort of a feature of the loan that the bank can give out. And it has a bit of the spends monopolist logic to it as being an extra feature, except that you have a distribution of loans across space, across sizes, etc. That's sort of potentially might vary, and people might ask about fixed costs, about the portfolios, whatnot. My question is whether you can find anything that would sort of validate the spends logic in a sense of other products. So essentially, either some quality of the covenant that the bank gives out, or something about the, like, I don't know, credit card programs, something like that, that would get rid of the covariance of the distribution problem. Okay.
So on the interest rates, I think that's definitely possible. We haven't really looked into the asymmetry or the momentum, but there's evidence showing there's asymmetry in deposit rate adjustment when during hiking and cycles. And so, yeah, it's something that we could definitely check in the future. So for the bank lending channel, we kind of thought that was already what kind of the DSS did in a QJE paper. So it's like how monetary policy transmitted to lending through banks of different deposit market powers. I feel like it's kind of like already there. So we sort of do the new left-hand side variable and then go a step further look into risk taking. So yeah. So for the other products, we do have some evidence. We didn't show it in the talk on the portfolio, on the security portfolios. We do say that they also seem to at least weekly increase the share of the assets with the highest risk weight. Those are more heavily associated with securitizations and so on. All right. Yeah.
Hi, Pari from Morton. Just a small point on Arvind's comment about the identification. Even if the shares are predetermined, there's still an identification concern. So there's some recent work by Yusak and Hall on shift share instruments with non-random exposure to the shock. I think you guys are assuming the shock is exogenous, but even the shares need to be exogenous too. So there may be something there to help you instrument the shares.
There's one thing that I'm stuck on, which is that you include firm cross-time fixed effects. So you're removing the credit component at the firm level. So when you're looking at loan level outcomes, the riskiness that you're capturing can be subject to some managerial discretion in the sense that, it may be the case that banks that have high beta decide to charge off more loans, or, that might be correlated with capital positions, and the outcomes that you look at the contract level may very well be correlated with the beta. Just wondering how you think about that.
Yeah, I mean, on the first, we'll check out that's useful. On the second, I think we didn't see, I guess I might have gone through too fast and dismissively on my balance table, as suggested by Arvind. At the loan level, there wasn't much difference on the collateral and seniority unconditionally. And so we don't see that, but I mean, maybe there's a conditional there has to be a conditional difference because that's what we're picking up.
Yeah, also I guess that that would really be a concern if the concern is that there's some kind of manipulation or discretion on the PD updates, and that would be heterogeneous across low and high beta banks. So I think another angle to look at this to look at the real effects, the post due loans and write-offs. So if it's purely from just discretionary PD adjustment at the bank level, then we probably wouldn't expect much difference in ex post loan performance. And we do find that, so we think that's also a way to corroborate the active risk-taking channels.
More questions? Okay, well, we're done. Thank you very much.